You can see my screen, right?
Yes.
Okay, perfect. Uh, Thank you so much for the invitation. I'll try to be on time, but please do interrupt me and give me the signals when I'm running out of time or if there are just a few minutes left. All right. Um, so this was my job market paper, where I try to connect the rise of the financial sector with the rise of inequality. And thank you so much for the opportunity to present it here. It's great to see some familiar faces as well. Okay, so let me start with the motivation of the whole paper. Right now, the so-called FIRE sector, the finance, insurance, and real estate sector, is the largest sector in the US economy that accounts for more than a fifth of it. Now, this has not always been the case. It's been the result of a gradual growth that happened after World War II, but it really accelerated only from the 1980s until the great financial crisis of 2008. And a similar path has not only been followed in terms of value added, but also in terms of amount of assets intermediated as a share of GDP. Now, still unclear. There are many explanations that have been put forward for why that is the case. Here, I will try to convince that inequality can be seen as an important component. In orange, you can see the rise of the top 1% in terms of share of income, fiscal income in this case. And in blue, you can see the rise of the financial assets the assets intermediated by the financial sector as a share of GDP from 1960 to basically COVID. Now, since there are some historians in the room, back in the days, they may be interested in seeing what I did back in the days, which is also considered a very long run explanation, a very long run picture. I could push this back to 1880, even though the data for the first 30 years are a little bit more scarce. But you will see exactly the same picture, except for Bretton Woods, where basically there was financial repression. So these two lines stop co-moving. And I tested the type of relationship also econometrically with more sophisticated tools, but your eyeballs already go in the direction that the two things really move together. Now, what am I trying to do here in this paper? I will give you a couple of slides, very high level, and then maybe I will spend a few minutes to look a little bit more into the descriptives and into the model that I built from a mile high point of view. Here, also in honor probably of Perry, the rise of the financial sector is seen as the rise of the shadow banking system. In this system, the shadow banking arises endogenously when the domestic portfolio needs of the investors face safe asset shortages. So that's where macro meets finance, where the equality part starts to meet with the financial decision. And I will be much clearer about this in a second. Therefore, the change in some compositions should really be understood as two sides of the same coin. We cannot speak about the rise of finance per se. Now, I'm not going to enter into the mathematical details of the model, but one could also say the opposite is true. A higher financial sector generates more inequality, which in my model will also be captured. So what do I need to get started is something simple to fix ideas, and then one can make it more complex. So to start with, the rise of the the rise of inequality will be generated only by a decline of the labor share. Now, I don't mean that that's the only reason that made inequality change, but it's the simplest reason to see how the model unfolds in my system. And then you can make things always more complicated. So when the labor share declines, as we see in the data for reasons that have nothing to do with finance, the capital sector increases. When that happens, also inequality is endogenously rising in the system. There is a compression of the real interest rates. I will explain why in the next slide. Households' indebtedness rises because that becomes cheaper. Leverage rises, and there is a rise of the financial sector as a share of GDP, which ultimately also feeds back on inequality. So I also do have this type of feedback loop channel. Why? So let me explain the mechanism. So when the labor share declines, the capital share rises. That means that the richer quantiles of the distributions have more savings under management. That's the picture that I showed you at the beginning, right? There's a rise in the income share of the top 1, 5, all the way up to 10%. The more you go in the top quantiles, the more that rise becomes extreme. So now you have more capital to invest. You have more savings to invest. What do? That's when I was saying macro meets finance. At the very least, those assets have to be allocated somewhere in a portfolio sense between risky and safe assets, broadly speaking, in a very coarse way. And if there are not enough public safe assets to adjust, to accommodate for this type of higher demand, that raises the prices and therefore compresses the real interest rates. But if that raises if that compresses the real interest rates, that means that also the debt issuance costs go down. Now, issuing debt becomes cheaper. But if issuing debt becomes cheaper, there will be now the households that are poorer that will like to do exactly that, to issue more debt to keep financing their consumption. So that's effectively where the shadow banking here comes in, because it creates synthetic safe assets. It's crowded in by this system where it can recycle the debt of the poorer households into the quasi-safe assets that the richer households are demanding for their hedging needs. And that's the overall idea of the paper. I also have a diagram, but I don't know if time will allow. I'm not going to go into the mathematics, of course. Okay, so in terms of contribution, of course, there is, in my literature, there is a contribution in terms of linking endogenously the rise of the financial sector with the shadow banking sector and all the 5 major macro financial trends that I showed you before: compression of real interest rates, rise of indebtedness, leverage, blah blah blah, inequality. There is a connection that basically it's a little bit in the spirit of Ricardo, right? Of connecting the production technology this is a change, connection between the production technology and in banking, but also the Ricardian sense of connecting the factor income inequality with the personal income inequality. And then there's this feedback effect that very often is analyzed separately in the literature. Either one side, inequality leading to finance, or the other side, finance to inequality. Here I show a coherent and consistent framework when the two things actually get together to feedback on each other. I'll skip the methodological part. Here, in terms of stylized facts, these are very simple facts. So basically here, you see that the higher the income, the higher the amount of assets invested in the financial sector, usually 30 cents on the dollar. So for every extra dollar you earn, you tend to invest $30. And the more you go up in the quantile, the more you effectively increase the share monotonically, linearly, that you invest in the markets. And if you try to do that dynamically, not only statically, you see also the type of pattern that you saw before. So here, this is from the micro data. So this is households by household. This is no more aggregate data. But when you put together the micro data, you start to see exactly the same pattern. With the survey of consumer finances, you cannot go back before 1989. Therefore, that's when the survey starts. But you see something that is pretty telling. This is something that probably or maybe you're familiar with. So most of the rise of the financial sector has been driven by the other non-bank financial intermediaries. This is the gross measure. The traditional depository institutions have been pretty much flat over time as a share of GDP, and that is what co-moves with inequality. And that has also co-moved with the amount of safe assets that has been produced. Now, in this case, safe assets is the overall safe assets, public and private, but that does seem to respond to how inequality has moved over the past 60 years. Okay, so let me try to give you the model in one picture, what I was trying to tell you in words, and then I will wrap it up so that I leave time for questions and for the other speakers. So the top line is what I was trying to explain. Here there will be workers that own no capital. They only earn labor, their income from labor. And for simplicity, there will be investors that will only earn income from capital. You can add bells and whistles and put labor on investors too, but you want to keep things parsimonious for now, and also to help visualizing things. So you have effectively people that own capital, people that own labor, and by putting together labor and capital, you have output, right? You have GDP, and you have a certain baseline of inequality. Here, inequality will be driven both by the fact that the labor income is different from the capital income, and by the fact that within the investors class, there will be different type of investors. So some people will have capital gains, some people will have capital losses. So you may have broke investors. So investors doesn't necessarily mean you're rich, but on average, it does. So you have a whole host of investors, some broke investors, Jeff Bezos and Mark Zuckerberg. So you have a whole type of species, and then you have a second degree of inequality, which is between investors and workers. And then you can, if you want to add more sophistication, you can always do that. You can put also labor on investors or more inequality across workers. You can do that. Okay, so that's the shock that I was saying. The capital share goes up because the labor share goes down for a whole bunch of reasons, and that makes inequality rises endogenously in the system. Now, when that happens, the workers now are earning less, right? Because they own labor, the labor share earns a lower income, so their earnings goes down. Investors have more savings because their capital share promises higher dividends, that it promises higher capital gains. Therefore, their savings, their amount under management goes up. Now, the action, as I was saying, happens here because now that they have more money to deploy, they will also have a higher hedging demand. They will demand both risky and safe assets. So they will have a higher hedging demand, but the workers also will have higher debt demand in order to satisfy their consumption needs. So that's where endogenously the new intermediaries, the new shadow banks kick in to recycle this into debt and therefore provide loans on one side and safe assets on the other side. Now, the real interest rates need to go down here exactly because there is this pressure demand on prices for the safe assets. Indebtedness needs to go up because now the debt of the workers is going up. But since it's going up and effectively the income has gone down, also the leverage of the system has gone up. For now, there is no statement here about financial instability. Potentially, this will make the model extremely more complicated, but potentially I have to do it because that's the sense I got from the referees on the first round that I got. Now, one thing that is not in this picture that I was telling at the beginning is the following: when the financial intermediation sector rises, that will also help. Well, actually, here, when the investors invest more, that will not only increase the price of the bonds, but also the price of the risky assets. So the stocks, quote unquote, will go up in prices. The capital gains will go up. Now, when that happens, here there is another arrow that I'm not looking for cleanness, but it's very important. There is a feedback loop here. So the financial sector goes up, the asset prices of the capital assets go up, and that feeds back on inequality. So effectively, that becomes a loop eventually. Okay, I'll leave it there because probably I even took more than my time. I will skip the empirical exercises. But if you're interested in knowing more about the model or the empirical exercises, I'm happy to chat.
Thank you, Dario. This was great and very on time as well. We will proceed first with Danqing, and then we'll collect questions for both.
I will stop sharing the lesson.
Danqing, do you want to share screen?
I'm requesting it.
Okay, wait. We can make you co-host, so it should work.
Okay.
Can you do it now?
Let me
Because
do
I'm
it
not
again.
seeing the request.
Okay, share. Looks different.
I'm not receiving anything on my end.
Just a second.
Okay.
Is it on?
Yes. Can just
Okay.
I think yeah, perfect. It works.
Okay. I think it's what I intended. Okay. Yeah. So let me make good use of the 15 minutes. The paper actually presented paper earlier 1 year ago at the symposium, but today I tried to present a prelude to this paper. So with the time I have, I'd like to talk about now the title is called there's a new name, digital public money in it. So by definition, it's a digital form of central bank money accessible to the public. So actually, the difference between DPM and the CBDC is that DPM includes both retail and wholesale CBDC. So it involves both the central bank money that flows between central bank and the customers, retail customers, and central bank money flow between the central bank and the banks. That's the idea, that it encompasses the whole thing. So, and also CBDC is not a good name, not a proper kind of name to use. So that's why it's now DPM. So the prelude is something that actually initially get me start to think about this paper about 2 years ago. I discussed this actually a little bit with Sasha in Shanghai, and it started with a starlight example of a loan, and also a fundamental principle that I want to pin down behind credit relationships. And the background is that it was the time in which during which fintechs like PSPs like Ant is venturing into credit allocation, and so trying to make good use of the data and everything. Stablecoin is on the rise with as a payment instrument, and CBDC innovation gets a lot of resistance pressure from the banks. Banks are shunned from CBDC innovations a lot, as far as I know. So that's the background, and that was the time. And the example I started with was this one, and also the principle is here. It's a simple A and B between two parties. An IOU, A wants to borrow something like money, like a hard cash money or anything, from B, and B owns an IOU on its balance sheet. Then this simplistic kind of loan relationship, I say. Then why does B trust A? The loan from A is good, the IO from A is good. Has to be any of the combination of the three. Either B holds some kind of collateral, something of value from A, or B knows something of value about A, which is credit information, or A has given up a share of control to B. Can be a governance control, or can be some equity share. In either way, or it's like in another scenario will be intercompany lending within a group if they have some equity relationships. So B trusts that the loan from A is good, the ORU from A is good from one of the three at least. If that's the case, I say the principle says that it is good, it's healthy, it is substantiated. And if not, if B has nothing and just give out a loan, then that may be problematic. It's more prone to crisis. That's the idea. So this idea sounds right, at least to me. So I had this idea back in mind, and I looked at a typical bank loan, in which it is going to be a swap of IOUs, bank loans to customers by generating a deposit on its liability side. So on the bank's balance sheet, which is on the right, the bank loan is supported by banks getting the collateral or credit information collect and assessed on its own. So it has the confidence that they trust that the loan is good. However, the other IOU, the deposit, that the customer holds on its balance sheet, it's thinly supported. Little information, little disclosure from the bank whether the bank is good. The bank doesn't have really any obligation to disclose healthiness of its financial healthiness to customers. So the problem is actually with the IOU on the top, the deposit part. And typically, central bank comes in, support. So additional support comes from the central bank in the form of a deposit insurance, lend of last resort guarantee. So only with that, with that kind of additional support from the central bank, customers are willing to use the bank deposit for payment means and willing to hold it actually. So it is the central bank that substantiate the kind of trust. And to balance that, central bank also require the bank to fulfill the regulatory requirements, capital requirements, liquidity requirements, and compliance, and all sorts, or the whole set, to ensure that the bank does not overuse of that. Of course, there's issues with incentives not misaligning in that, but that's the current case. That may actually make it work. That the both IOUs seem to be well to work at least in good times, and here it is. And banks constantly do two things that with this kind of setup. First, the bank will try to make the coverage of trust, the deposit insurance and lending as valuable as possible. So bank will try to expand the balance sheet to make it large. And second, the bank also try to shrink the regulatory requirement on the right-hand side to make it as little as possible. And so that's it. That's the issue we have in place. And the second issue is that lend of last resort, as it says, is always kicks in only after crisis, always when it's too late. Already it's too costly to cover the loss. And when it is a crisis, it's a judgmental call, a very difficult call for the central bank. So these are the two issues with the current one, although it seemed to work in a good time. And this picture actually illustrates, it's like one picture illustrates the DPM scheme. So rather than fixing the issues with the bank deposit with this IOU, try to replace it with digital public money. So the bank lends, still bank is in the lending business, is in the business of credit allocation, as I say. So, but the banks lend not the bank deposits, but in the form of the digital public money. And bank gets the money from the central bank. So central bank is the money creator, the only money creators. Bank balance sheets are not used for money creation. Only the central bank balance sheet is creating the money, and it's providing the liquidity to the banks through the central bank loan. And here, central bank loans are supported by banks' disclosure to the central bank, banks' collateral posting to the central bank, and as currently does the regulatory requirements. So in the three things in the original, in the principle I mentioned, the information part, the credit information part, the collateral part, and the regulatory requirement, in some sense, the governance part. The banks give up some of that to the central bank, in return gets the liquidity from the central bank, and then the bank, it's like the wholesale part. The bank gets wholesale digital public money from the central bank, which it lends at a different rate, at a higher rate to the customers. And that's the scheme in a nutshell. Well, to complete the picture, the customers, the retail customers are willing to hold central bank digital public money because the central banks have mandates, but central bank has this governance structure laid stipulated by the legislature, which customers are part of it. And it requires governance structure, transparency, accountability, so that the central bank have confidence that the money is good. The money is good in terms of price stability, inflation target, and all the things that central bank is currently doing. So the customers are willing to receive and hold this liability from the central bank. So that completes the picture. But the difference is from the previous one is the bank deposits disappears. It does not involve the bank deposits. So the role is the segregation of role is that the bank still in the credit business, but only the central bank is in the money business. And one is public, and the other is private. That's the idea well, compared to the previous one, when we say we notice just the regulatory requirement part by the bank to the central bank are now replaced by the central bank loan. So in a comparison of that, the central bank loan is a hard constraint, and it's an ex-ante constraint. It's not taking place after the crisis has hit. And it's hard in the sense that if the bank can no longer get more loan, cannot get more money, and the bank the asset is deteriorating, the bank face bankruptcy. The bank kills the bank, and it's hard. It's a hard constraint. Central bank will not be. That's rule that the central bank loan are rule based, so it will not like give discretion to say keep lending more to certain banks. And the rules are first it's based on capital adequacy, which can be in par with the current Basel rule. And in terms of collateral posting, the haircut rule can also be on par with the current collateral framework. But in comparison, this bank regulation are much more effective, much more direct compared to the regulatory requirements before. So on the bank side, the key difference is that banks now, as credit allocators, now they are allowed to fail. Let's see what happens when the bank fails. Because on the liability side, banks are supported by equity holders and the central banks loans. So when the bank fails, it impacts only the equity holders and the central bank, with no impact on the firms and households. A firm tells that they still hold the public money good, and so there's no monetary system instability, and banks are allowed to fail and possibly fail fast. From the retail customers, now getting a loan doesn't not mean funding the bank with the bank deposit. Getting a loan is just a loan. It's a simple credit relationship with the bank with no strings attached. Banks are funded by the central bank loans. So that's the decoupling, and that makes bank regulation also easier. Is that good news or bad news to the banks? To the existing big ones, probably not so good news. It's the same reason why central bank and banks are well, but to the innovative banks, to the new entrants, they will see that it will become a new opportunities, a new way for them to be accessible, to get into the central bank loans, to be able to participate in this credit allocator business. So they can be new opportunities for the new banks or for the more innovative banks. So it depends on which kind of banks we're talking about. Final piece. If we look closely at the bank's balance sheet, it can be funded by equity, by CB loan, by bank bonds, by interbank loans, and by deposits. Let's say it does not rule out deposit at all, but it just can be funded by any of all of those. And we rank the kind of disclosure, the magnitude of disclosure by the banks to the shareholders is the most. By the bank to the central bank, almost the most, not as much as shareholders. By the bank, when issuing bank bonds to the investors, a lot. Interbank loans to the financial institutions, quite a lot. But to the deposit to the customers, very little. So bank funding by this ranking of disclosure should come most part by shareholders and central banks due to their information advantage, because they are the best to assess whether they can trust the bank to fund the bank. And that's the takeaway now from this principle. If I say this at the very beginning, as a first slide, it would be like a crazy idea. But if the principle is not that crazy, and we have this DPM scheme in place, it doesn't seem too far-fetched to at least give it a thought. And that's it for my show. Back to you, Sasha.
Thank you, Danqing. Okay, so we are good with time, and we are now open for questions. If anyone wants. Yes, Barry, please.
So can you hear me?
Yep.
Yeah. So I have one question for each. Dario, you don't mention globalization, and you say that the wage share is sort of exogenous in your story. But I wonder if in the back of your mind you have a notion that this is because of globalization, that American workers are competing with Chinese workers and so forth. And the other dimension of globalization, after 2008, arguably one of the things that happened was that shadow banking went global, that the crisis was about, the subprime mortgages, as you say, which were being booked in Europe largely offshore. And the crisis basically led to globalization of that from the global south issuing bonds, which were bought by Japanese insurance companies and funded in Europe and so forth. So maybe not for this paper, but to have in the back of your mind as a next paper, and you want this paper to be consistent with what the next paper is going to say. So if you have some words about globalization. Second question for Danqing. You speak about digital public money, but why is digital important here? I didn't see anything there that would require digitalness, in order to make this work. In fact, this sounds to me similar. I can't get the reference off the top of my head. Something that Jane DiResta used to propose for the United States, as a matter of fact, and it didn't have anything to do with digitalization. It had to do with the relationship between the central bank and private banks and credit control and monetary control and so forth. So this is not, I believe, quite as crazy and new an idea, but perhaps it's more implementable because of digital. I mean, so I ask a question. Is the digital piece essential?
I will go first, just so dinner. Yes, if I add globalization, everything I said becomes stronger because now you have even extra pressure coming from the outside, which will compress the interest rates even more. Now, will I do it in this paper or in the next one? This is a question that I received before. Potentially, there is a streamlined way to do it here without entering into too much sophistication of what the Japanese or the Europeans are doing. But for sure, it's something that can be added, at least in a stripped down version. And the reason why I didn't mention globalization is not to say it's important. It's because to some extent has been studied, has been highlighted. So this was more of a complementary reason, not a substitution reason. But if I do add that, everything I said becomes stronger in terms of quantitative results. So I'm 100% agree with you. Now, let me say, it's not my literature, the one on workers and globalization. For sure, you can make that claim. It's a nasty literature I don't even want to get into on the earnings side, because then you have to start to play with the people that work in the labor share, the Acemoglu's of it's horrible literature, and it's not my focus here. I don't want to play with it. So that angle of globalization on the worker earnings, I'm not gonna touch. The global part of shadow banking, yes, that I can do, and that will make my results stronger. I will decide. I don't know if I will do it in this paper or in another one, because to some extent that has been touched in the literature, but it's for sure something to keep in mind, and that I also try to be careful in the paper about. Thank you.
Digital. If it's not digital, nobody's using it today. But that's not the key reason. Digital makes the money able to be remunerated. If it's up cash, it doesn't carry interest. I didn't mention in this 15 minutes, but the CB loan carries a rate. The bank loan has a rate which is higher, and the digital money also carries a rate, which if the central bank is playing the zero profit policy, then the digital public money's rate is on par with the average of the CB loan rate that the central bank is giving to the banks. And it's all three rates are part of the monetary policy toolkit. So it has to be digital to make this work in some way. That's the current reason I'm thinking.
Do we have more questions? Alex, do you want to share your question for everybody here?
Yeah, well, I asked a question to each of them, and they both already answered in the chat. For Danqing, I was asking, how do you prevent banking from kind of just happening on its own, offshore places that aren't regulated? And his answer was good, just that it's going to be a competition, that people can try to do that, but the DPM scheme is going to be, pretty competitive and maybe outcompeting other banking unless there's something that's, I don't know, preventing people from accessing the DPM if you're in a foreign country with capital controls or something, presumably, or something like that.
Do we Anush wanted to say something?
Hi, sorry, I don't know why my camera is flaking out. Thanks for the DPM presentation. I'm a bit of a skeptic, but I'm just trying to understand the mechanism. So just to clarify, the loan sits on the bank's balance sheet or the central bank's balance sheet? Where does the loan sit?
The loan sits on the bank's balance sheet. The central bank loan sits on the central bank's balance sheet.
Yeah, but the retail loan sits on the retail bank's balance sheet, right? So
right.
So that's an important piece vis-a-vis unwinding. Thank you for clarifying that. So how does then failure not matter? Because then if the flip side of that is that loan is no longer there it's no longer there as a liability, but it's also no longer for the borrower, but it's also a marginal source of liquidity has gone away, right? So I feel like there has to be some spill. You were making it sound as if failure is neutral to the loan recipient, but I'm not so sure if that's true. If the loan is sitting on it may very well have more stability properties, and I sort of concede that, and I kind of agree with that. But I'm not sure it has neutral liquidity properties, and that brings me on to my second point, which is that, in a way, why I'm skeptical about central bank digital currencies in general is a sort of Hayekian point, which is that, in a way, it's not just that money is a hierarchy obviously for chartless reasons. It has to be a hierarchy, which is to say it has to be a system that's simultaneously centralized and distributed, because the centralization performs some function and the distribution performs some functions, right? And so in a way, what we do with schemes like yours is that we've shifted the marginal liquidity decision away from the capillary level of a system where I may have more, as a bank, I may have more local information, to a central level, because marginal liquidity now has to go from the central banks to the commercial banks, right? Why? And one can raise a kind of Hayekian point here. Why would the central banks know how to allocate, or would they just passively allocate marginal liquidity to banks that need it, and therefore banks could game them? So my point is that there is a sort of, and again, I don't want to over egg the Hayekian pudding, so to speak, but I think there has to be a informational advantage to having a system that is distributed. Of course, Hayek hardens that into an ideology. It has to be all distributed, and that has its own problems vis-a-vis stability. But in a sense, the digital public money has the inverse problem. It's too stable. It's not flexible enough. It's not flexible enough, especially at the lower reaches, where you need to kind of get liquidity to the capillary granular levels of the economy. And if you have a central allocator, I should foreground this by saying I don't think banks should be in the private sector at all. I disarticulate completely the requirement for banks to be distributed and centralized from the ownership of such a system, right? So I can imagine a public system. I mean, both of our countries have that system, which is both widely distributed and centralized and nationalized. So the ownership status is entirely distinct from this requirement to be simultaneously centralized and distributed, which is a hierarchy. But so yeah, I'm just wondering if So there's a liquidity issue on the one hand and the informational one on the other.
Let me answer the second question first, the hierarchy question. It is very important that in this DPM scheme, the hierarchy is still preserved in an informational sense, as you put it. The banks are credit allocators, so the information regarding like local customers, the bank's customers, this information are retained by the banks. The banks still do the same thing, and the central bank doesn't need to touch this part. And actually, the central bank delegate that role to the banks, so that central bank doesn't need to deal with retail customers in terms of that part.
Then there's an asymmetry problem. Sorry to interrupt, because then how does the capillaries doing the allocating, and they just don't have the liquidity to act on that. They have to go to the central bank to get that marginal liquidity.
Yes,
and so they have an informational advantage.
They have three, and the central bank looks at three things possibly. First, information, but that's portfolio level information of the banks, which is like the disclosure kind of obligation currently the banks are doing with the central bank. Only the asset portfolio, that's on, but not detailed retail customer part. So central bank gets to look at information, look at the collateral. The banks can be posting collateral, same as the current collateral framework that central bank has offered to the banks. The third is central bank also stipulates the kind of governance regulatory requirements, and all three things support the central bank's loans to the banks, and all three things are what the central bank is already currently doing, but not effective, not like in a open and the rule-based and the effective way, and some are done maybe so central banks in some way is still in the top of the hierarchy, looking at the high level kind of money system, kind of distributing this money system. The central bank to fulfill its mandate, not much different from the current, but the only difference is taking the money creator part away from the banks, so that they do not need to protect the banks as a money creator, as currently it is. And so that's but the hierarchy is still there.
We should workshop this idea. This is I want to get into the weeds of it, but this is interesting.
Thank you both. We are going to now proceed with Josh Mason, who has joined us, and it's great to have you, Josh. We have all been following your work for a while now, and it's good to have you for our workshop here. You can share your screen and we're good to go.
Oh, I don't have slides or anything like that, so no need to share the screen.
Okay.
I didn't have much time to prepare. I was asked to do this at the last minute, and it's a more technical group than I'm used to talking to, but hopefully we'll have something to say. So, the starting point for me, at least, is the sort of old orthodox ideas about money that we're all familiar with, going back, to the beginning of the economics profession. The idea that we have some distinct asset that is money that exists in a definite quantity, and that it is in some sense neutral with respect to real variables. So, the classic statement almost 300 years ago from David Hume, that money is nothing but the representation of labor and commodities, serves only as a method of rating or estimating them. Where coin is in greater plenty, as a greater quantity is required to represent the same quantity of goods, it can have no effect, either good or bad. The early statement that you can find versions of right down to, members of the Federal Open Market Committee today. So, the idea of money existing in a definite quantity is maybe not as central to textbook orthodoxy today as it used to be, but certainly the idea that money is neutral very much is. And I think that the quantity view is implicit in a lot of conventional wisdom about money and finance and central banking. Now, all of us in this group, I think, have no trouble rejecting this orthodox view and understanding that money is endogenous and is not neutral. But I think we don't always necessarily think through all of the implications of taking that view, because I think that the view again of money as endogenous and non-neutral is actually going to lead you to some more radical places than are obvious at first glance. So, this sort of orthodox view really goes with a kind of vision of the economy, as Keynes sort of described it in his struggle to escape from it. He contrasted the real exchange view of orthodoxy with what he was trying to develop, a monetary production view of the economy. He says, in the real exchange view, essentially, you have a set of commodities that exist actually or potentially, and these are going to exchange at some set of relative prices, and money is simply the facilitator. It's not fundamental to the basic trade-offs involved in the sort of allocation of these existing commodities. Whereas, as he put it, he wanted a monetary production view, meaning, quote, a theory of the economy in which money plays a part of its own and affects motives and decisions and is one of the operative factors in the situation, so that the course of events cannot be predicted either in the long period or in the short without a knowledge of the behavior of money, end quote. This is a vision where the operation of money is central in driving real outcomes, where money plays an organizing role in the economy, and again, that you can't understand real outcomes without understanding money. And I think, as I'll talk about in a moment, I think the production side of this is as important as the monetary pole of this, although I think people in the Keynesian tradition have often struggled to keep both of those poles equally central in their thoughts. But I think they have to be, because the importance of understanding money comes from the fact, I think, that taking money seriously implies a very different vision of the real economy as well. So I think, if we start, let's start in terms of thinking about what I have in mind here with the interest rate. Again, I think we're all familiar with sort of this contrast between the loanable funds vision of the interest rate, in which the interest rate in some sense represents a trade-off between consumption today and consumption in the future, on the one hand, versus a sort of financial vision of the interest rate, where the interest rate is fundamentally the relative price of two assets or of two promises of money payments. Now, people often, I think, talk about this as if these can both somehow be true or somehow just be two different ways of talking about the same thing or two different aspects of the situation. But I think these are actually really quite incompatible views. And if we take, what I'll call the money view, even though I probably shouldn't even use that phrase with Perry in here, if we take, what a financial view of the interest rate, I think if we take that seriously, and we think consistently of interest as a price set in financial markets and follow where that leads, then we're going to end up with a very different understanding of interest than a lot of conventional discussions of that suggest. So first of all, most maybe obviously, certainly the aspect of it emphasized by Keynes, if we take interest seriously as a price set in financial markets, then the decision to save has no effect on interest rates. Or I should say no direct effect on interest rates. First of all, for the reason that Keynes himself emphasized, which is that my decision to save is equally a reduction in someone else's income. So my decision to save does not influence aggregate savings at all. It's simply because in reducing someone else's income, I've reduced their savings by exactly as much as I increased my own. And this is already an illustration of why we have to think about the production side of the economy alongside the monetary side, because the situation in which incomes are being determined by spending decisions, although it clearly describes the world we live in, is very different from a world in which there is a pre-existing set of commodities to be allocated. And of course, the decision to save does not in any sense enable new loans to be made. The transactions in which the interest rate are set are either ones in which two existing financial assets are swapped, as in the bond market, or transactions in which two new assets are created in the form of offsetting IOUs, offsetting promises of future money payments, as in new bank loans. So there is no transaction in which savings are a source of new loans, and therefore no route for a change in aggregate savings to influence the interest rate, even if individual decisions to save could influence aggregate savings, which they cannot. So already this takes us somewhere very different from a lot of debates about interest. Second, and somewhat relatedly, there's no effect, I should say, of inflation on the interest rate at all, in my view, except via central banks' responses to inflation. There is no sense in which a change in inflation rates directly influences the interest rate. Again, because the interest rate is a trade-off of two flows of money payments, both of which enter inflation of which enters into both of which equally. Or to put it another way, there's no sense in which the interest rate is a swap of future commodities for present commodities, and therefore the relative price of future commodities compared with present commodities has no role in determining the interest rate. The interest rate is always a swap of money commitments or promises of money payments, and therefore there's no reason for the inflation rate to influence it. And I think you can see this pretty clearly on an empirical side if you look at the United States, for instance, in the 19th century, when we didn't have a central bank, and there's really no relationship between nominal interest rates and inflation at all, even though there's quite a bit of variation in inflation. So I think, corollary of this, we really should reject the idea of the real interest rate. Those are not words that refer to any object in the world. Third, spreads are really all that there are. There's a sort of conventional way of talking about interest that sees the interest rate as determined in one way, and then a set of spreads determined by, typically some form of risk premium above that. But I think this is wrong, and I think it's wrong again if we take seriously the idea of endogenous money. If we take seriously the idea of the interest rate as being determined in financial markets, then the sort of transaction that determines the interest rate is no different from the transaction that determines various interest rates. In fact, they're really the same transaction. Again, it's just the relative price of two different financial assets. And Keynes, again, actually says this or suggests this in a footnote in the general theory, where he says we could pick as our definition of money any subset of sort of the shorter end of maturities. We could cut off whatever of the shortest end of maturities we want and call that money. And of course, that implies that we can pick whatever segment of the yield curve we want and call the slope of that segment of the yield curve the interest rate. And I think this is an intuition that we should follow. This is an insight that we should take seriously. Even though I should say it creates some real problems for Keynes's presentation elsewhere in the general theory, where he does not follow this idea consistently himself. But I think he's correct. I think there is no such thing as the interest rate as apart from spreads, which, incidentally, Steve Margolin in his big book on Keynes says the same thing. He says, oh, this is a problem with Keynes's account of the interest rate. It's only a theory of interest rate spreads. I think he's right that it's only a theory of interest rate spreads, but I don't think that's a problem. Fourth, still talking about the interest rate here, there's no such thing as the natural interest rate. This is really an idea that's adopted by central bankers and people who talk about monetary policy as a way of reconciling a kind of non-monetary vision of the world with the actual practice that they're engaged in of influencing prices in financial markets. So, if you look at the way people talk about the natural interest rate, let's say Jay Powell a few years ago in a speech, he introduces the idea of R star by saying, in conventional models of the economy, major economic quantities such as inflation, unemployment, and the growth rate fluctuate around values that are considered normal, natural, or desired. And I think that's really a very nice illustration of how this idea of R star or the natural interest rate functions, because of course, normal, natural, and desired are three very different things. And yet here with this definition of R star, we're conflating them all together. Is this normal as in typical or average? Is it natural, meaning in some sense determined by factors outside of conscious human control? Or is it desired, meaning the rate chosen by the central banker that produces the outcomes that the central bank wants? And I think the slippage between these different concepts is really essential to the function of the natural rate. because the natural rate is really almost like a clutch. If you think of the clutch in a car, you've got the engine turning at one speed and maybe the wheels are turning at a different speed. And if they just jam together, your drive shaft is going to break. So you need to sort of have something that can allow them to turn somewhat independently of each other while still being in contact. And I think this idea of the natural interest rate kind of functions as a clutch between a theory of the world, which is essentially a non-monetary vision, the sort of macroeconomics that's taught in graduate schools, which doesn't have any role for money or finance, where there's simply a trade-off between consumption today and consumption tomorrow, and then the actual activities of central bankers, which obviously are deeply, deeply dependent on the existence of finance and the structure of finance. So I think this idea of the natural rate really is sort of this ideological bridge between what central banks do and a theory that is really not consistent with that. And then finally, thinking still about the interest rate, and I think again where I would argue taking the idea of endogenous money and non-neutral money seriously gets us is that money and credit are not neutral in the specific sense that they always are going to shift the composition and direction of economic activity as well as the level of economic activity. In our older vision where we think of a quantity of money that's somehow directly linked to the price level, you can think of that money kind of diffusing evenly throughout the economy. This is, Irving Fisher's metaphor of the level of a lake. You add water to the lake and you just you raise the level of the lake everywhere. He says, you don't need to worry about all the specific ripples and waves. That doesn't undermine the existence of a water level in the lake as a whole. That's Fisher's view of how the price level and the money supply are related. But when we're thinking, as we should, obviously, in the sort of vision of the world that we have of credit rather than a quantity of money, bank created money, credit is always credit for someone in particular and for something in particular. You don't just add credit to the economy in a generic way. You make loans to somebody for some particular activity. And some activities are much more credit constrained than others. This, obviously is a sort of version or restatement of Minsky's two-price model, where you have long-lived capital goods whose price is more sensitive to the existence of liquidity. He still talked about a quantity of money, but the availability of liquidity, the terms of financing matter for the price of long-lived capital goods in a way that they don't matter for the price of current output. And of course, we could extend this because it's not just two prices, but it's many prices. All sorts of different, capital goods are more or less specialized, more or less able to be sold in secondary markets, more or less long-lived, and therefore more or less sensitive to credit conditions. And so whenever we talk about changes in the supply of credit, we're talking about redirecting activities between those that are relatively dependent on liquidity and ones that are relatively less dependent on liquidity. So I think, again, when we say banks create money, this is almost conventional wisdom. I'm sure I'm not the only one maybe in this room who assigns students the nice explainer from the Bank of England on how banks create money. Every semester I teach macroeconomics. This is very familiar stuff. And yet I think when we follow these ideas, we end up in some very unconventional places. I think, these ideas of sort of neutral money and therefore some kind of non-monetary underlying barter economy are very deeply wrapped up in a lot of ideas that economists have in ways they're not necessarily conscious of, and that if you want to untangle that, you're going to have to unravel quite a lot of sort of ideas that we're perhaps relatively more comfortable with. And although, our natural and sensible humility should discourage us from thinking that we understand what central bankers do better than professional central bankers themselves do, I think we do, if we want to follow these ideas and take them seriously, have to challenge at least a lot of the language that central bankers use to talk about what they're doing. So that's sort of the interest rate, but I think we have to also talk about what a kind of taking seriously the idea of endogenous money and non-neutral money taking seriously what that implies about the production side of the economy. Because again, I think we say there's a monetary production vision that is kind of at the heart of what I would say is the true Keynesian revolution, and in which sort of liquidity and ideas about money are central. The production side of that dyad is just as important as the monetary side. And I think in particular, the endogeneity of money matters. The reason it actually matters that banks create money, the reason it matters that there is a continuum between money and all sorts of other IOUs and promises that can be made in a flexible and elastic way throughout the financial system. The reason that matters is because the productive capacity of society is also endogenous. The productive capacity of society is also flexible and open-ended. If we had a flexible and open-ended monetary system, but we had a rigid, fixed productive system, well, that's sort of the world, I suppose, that a lot of discourse around monetary policy implicitly imagines. And the only challenge is keeping the endogenous money growth or credit growth in line with the fixed and given growth of productive capacity. If that were the world that we lived in, this would just be a technical problem, and there wouldn't really be any real stakes to this. But I think there are stakes because I think that we have to take seriously the idea that the production is also endogenous and open-ended. A monetary production of the world, in other words, is one in which the fundamental economic process is not one of exchange. The fundamental economic process is one of collective transformation of the world in order to better meet human needs. This is an active process. It is structured and mediated by money. It is organized by money payments and the promises of money payments and the pursuit of money incomes and assets valued in terms of money. It is organized around the accumulation of money. But production itself is a cooperative human activity, and its possibilities are not knowable in advance. In this monetary production paradigm, the fundamental constraint is not scarcity. The fundamental economic problem is not allocation. The fundamental constraint is coordination. When we stop imagining the world in terms of discrete commodities being combined in different ways and start imagining in terms of human beings cooperating or failing to cooperate to do things together, then the problem becomes, how do we coordinate the activities of all these different people? What does it take to allow cooperation on a larger scale between people who don't have pre-existing relationships? In other words, if we see money in a more realistic way, then we can stop imagining the rest of social reality on the model of money as a sort of homogeneous substance that exists in definite quantities, and we can instead see active cooperation and relationships between people. So if we see production in these terms, then we have to, again, reject a lot of ideas that we're familiar with and embrace some other ones. In particular, we have to take seriously some ideas that fortunately have been taken more seriously in the last 15 years or so, like hysteresis. The idea that both our technology and our labor force adjust to actual output, so that potential is endogenous to the level of output itself. We have to take seriously the idea of increasing returns, so that the level of production, again, can influence the productive possibilities, and you can have activities that are not profitable, that will not deliver a return greater than their costs if carried out on a small scale, but will do so if they're carried out on a larger scale, which is, of course, one of the important reasons why credit is so essential and has such far-reaching effects in shaping real activity. And we have to similarly take seriously the idea of learning by doing, that there's a path dependence to our productive capacities. All of this means rejecting the idea of scarcity, of a fixed amount of potential output, of hard trade-offs between consumption today and consumption tomorrow, or in particular, I think very relevant today, hard trade-offs between material living standards today and taking action on climate to decarbonize the economy. I think we need to reject the idea that there's a trade-off between those. And again, I think that actually follows in some sense from taking money seriously. This also, as economists, means that we have to reject the idea of any sort of economically meaningful long run. We think of the long run as a situation where the capital stock, as well as employment and relative prices, have fully adjusted to technology and preferences. But in our monetary production vision of the world, technology is just as endogenous. The labor supply is just as endogenous as the capital stock is. There's no sense in which there is a set of fundamentals that we can treat as fixed and then ask what is the long run path by which the other variables eventually adjust to them. We have to take seriously the path dependence of productive capacities, and therefore there's not a set of parameters that we can use in describing a long run path of the economy. And we also have to reject the idea that markets are the central coordinating device in the economy. We have to rethink the role of markets. Because again, when we start thinking about the production side of the monetary production economy, and we think that this is an effort to solve the problem of cooperation, it's an effort to solve coordination problems, then we say, well, how is cooperation production actually organized? And of course, when we look at that, we say, well, it's organized through corporations and other firms, and that internally, these are not organized through markets. They're not structured through money payments. Workers have to be paid a wage, of course. Shareholders expect a dividend. Suppliers have to be paid for their inputs. But once workers have showed up, there isn't any sort of internal market for their services. The boss just tells you what to do. Nor are corporations organized internally around pursuit of profit. You have divisions, you have executives, managers who are again acting in some sort of structured cooperative way that does not involve incentives or money payments for the most part. So when we're looking at the internal, so again, we have to say, then what is the function of markets if we actually have these enormous arenas of planning in the production process itself? And I would argue that where markets are needed is essentially to facilitate new forms of cooperation among strangers. That money has historically played an essential role in breaking up old kinds of relationships, more local, smaller scale forms of production. The classic, line from the Communist Manifesto that we all hopefully are familiar with about all that is solid melting into air, all fixed, fast relationships being dissolved. This is a fundamental role of money in facilitating new forms of cooperation on a larger scale. So we could think of money as a specific kind of technology of social coordination, as a way of organizing human activity in new ways that it hasn't been organized before, as a way of extinguishing obligations, dissolving existing relationships, breaking up existing ways of organizing production, and freeing up the human beings and other resources involved for organization on a larger scale. One implication this has, going a step further, is that the function of markets really doesn't depend very much on getting prices right, because the essential thing is the anonymity of markets, the way markets allow coordination without ongoing relationships, without commitments. That is the arm's length quality of markets is the essential thing that they contribute to the organization of production, and not price signals as such. So this might seem at this point quite a long ways from from sort of thinking about how banks create money. And obviously I haven't argued step by step why you have to end up here if that's where you start. And perhaps strictly speaking, as a matter of logic, you don't. But I do think that Keynes was right, and I think people in that tradition are right, to see taking money seriously as having far-reaching implications for our vision of production and our vision of the economy. And I do think if you take endogenous money seriously, if you take the non-neutrality of money seriously, if you take the existence of finance seriously, if you start from the assumption that finance is doing something useful, then I think that you may end up in some places that you didn't expect. And I think I'll stop there.
Thank you very much, Josh. That was really, really good. I can start with a question. Alex has some questions and he can then ask them afterwards. I have a number. Well, let me start with big picture questions. So when you say that financial markets determine interest rates, and we simply need to start by that, acknowledging that fact, and that financial markets are ultimately about, if I understood you correctly, swapping one cash flow for another. Is that the right way to put it? How do we compare what kinds of different cash flows get to be swapped, and how do we get to compare them? Because that feels to me to be the kind of a fundamental variable of this way of thinking, right? What kinds of things are offered and what gets to be swapped, and then how do we think about that process so that we can understand what's going to affect interest rates? Second, if we start by saying that money is endogenous, but then we also say that the technology and labor are endogenous as well, I guess the question that I would have there, endogenous to what? Because it feels to me that the way we use the concept here is in the traditional endogenous money theory is that banks extend credit money based on non-monetary variables, exactly as you said, so that money is then somehow endogenous to some non-monetary, more fundamental process, right? Which is, I agree, something that we need to at least scrutinize really critically, if not abandon completely. So, but then if we do, and if we go towards saying, ultimately those real parameters like labor and technology are endogenous as well, then I guess that begs the question, endogenous to what? These would be the two big questions I would have. Then there would be another thing that kind of comes out of Perry and how I understand what he has taught us, which is this notion of hierarchy of money. So when we think of the way in which is obviously a notion built around the credit money creation. However, in Perry's way of thinking about this, the idea is that ultimately, on a micro level, there are entities that ultimately face hard budget constraints for who rely on savings in order to fund their activities, whether their own or non-bank financial institutions who are going to lend money to them, and they themselves need to have someone saving, which doesn't mean that the overall system doesn't ultimately depend on credit money creation, but that to those particular entities, those non-bank financial institutions and those borrowers from them, the system looks like a hard money system. And they need to ultimately repay, right? They don't have the types of elasticity that maybe can be found higher up in the system. I don't know whether that's something, and that would be a realistic point of view, right? Like a point of view that still acknowledges endogenous and credit money creation, however, doesn't generalize that in terms of saying, despite that being the case, the different kinds of entities experience liquidity constraint, survival constraint in different manners. So I guess that those would be the kind of questions that I would. What would you say to that? Like how does a micro aspect of this macro theory that you're providing looks like? And are there any specificities there that need to be added, or that you want to bring up as well?
Would you like me to answer that right now, or should we take a few questions?
If you can, that's good, I think, and then we can go. We don't have too many people, and we still have some time.
So you asked three questions, I think. The first one is, if we think financial markets are about swapping cash flows, then what kinds of things get traded in financial markets where the interest rate gets determined? I think, so let me say to that, first of all, I think it's a small difference, but I think the language I used was swapping assets. And I do think it's important that when you buy or sell an asset, or, it's never just the cash flow associated with the asset. Assets always have other qualities as assets beyond the cash flow they promise. And I think that's actually quite important here, at least in some contexts, and certainly in thinking about the interest rate, because liquidity is a property of an asset independent of the cash flows that it promises. But I think on the other side, I think this is a critical point, that this is, in a sense, why we have a financial system. This is I do think, everybody, I'm sure, has seen Kevin Warsh's, comments about, which you sort of feel like at his press conference, which are like, why do we even have a Fed if you really think this way? But you could go the next step. Why do we have a financial system? If we have kind of a system in which rational far-sighted agents can just swap their capacities to work to meet their needs at any given date in the future, then why do you have a financial system? Obviously, the reason you have a financial system is that the vast majority of promises that people could potentially make are not credible. This is why Minsky says the real task of the bank is not intermediation. The task of the bank is acceptance. The task of the bank is to make promises credible that people could not directly, accept from each other. And so the whole point, I would argue, of the financial system is, in a sense, to answer the question that you asked. What kinds of promises can be swapped? What kinds of promises can enter into the markets where interest rates are determined? And that is why, I think finance is useful. Again, one thing, Arjun and I say in our book, Against Money, people know, is that in some ways we think that the idea that finance is useful is actually almost a more radical proposition than the idea that finance is useless or parasitic, because a world that needs finance is a very different sort of world than the textbooks teach us about. So I think that's really putting your finger on something very central to this conversation. The second question, you say production endogenous to what? Well, in the first instance, I would say productive capacities are endogenous to the actual level of activity in the economy, which depends on the level of spending in the economy, which depends on the terms on which credit is created. So the terms on which credit is created determine, again, the level of activity, which determines the productive capacities of the economy. So that's another way of saying there's no sense in which we can think of the financial system as reallocating an existing pot of production over time or across uses. And I do think in this context, endogenous money obviously has been used with some different meanings. And in some contexts, it just means that the money supply adjusts to bring the interest consistent with the interest rate reaching some exogenously fixed level by the central bank or by someone else. And I think I have in mind a sort of more, Bob Poland, my dissertation advisor, wrote an article. I don't think it's very widely read, but it had a big impact on me, where he talks about interest rate endogeneity is sort of the next step beyond money endogeneity. That the point of talking about endogenous money is not simply that the money supply passively adjusts to satisfy an interest rate set by the central bank, but that they're autonomously determined within the banking system, and the terms of the interest rate and more broadly credit availability are determined within the banking system. That's the concept that I'm trying to flag there. So there, yes, and at that point, again, the real side of the economy is as dependent on that as the monetary side. The last thing you said was that there is a hierarchy, so that many units face a survival constraint that requires them to settle their obligations in the accepted, using the accepted settlement asset, which implies a sharper line between money and non-money. So you can say, well, analytically, you can pick any part of the yield curve, any part of the spectrum maturities, and cut off some part of it and call it money. But obviously, there's a point of settlement where it's not arbitrary. Some things can be accepted and most things cannot be. So I think that's very true. I think it's very important. It's something I'd meant to emphasize and kind of skipped over, which is that the function of money in organizing production absolutely depends on the existence of a survival constraint. You have to have an intermediate degree of flexibility in the system for money to perform its function in reorganizing production. Because you have to, on the one hand, have credit available for new activities that have not yet generated any income, that have not generated any profit. You have to do things in defiance of market signals, whether it's AI or whether it's the early stages of green energy, things that have not demonstrated their ability to generate a profit, but somebody believes that they will, and therefore we will endogenously create the means of payment that these activities need to finance themselves. That is absolutely central. But it's also equally necessary that there be many other actors in the economy who do not have that degree of flexibility and can only meet their survival constraint or meet their subsistence needs by acquiring money from somewhere else. You need to have other entities that exist in a hard money world so that they will provide the actual concrete contributions to production that these unconstrained actors or units are going to carry out. So you absolutely need the existence of a survival constraint for some units, along with a soft budget constraint for other units. And yes, it looks like a hard money world when you are the one who has to meet your payment obligations. And that's absolutely right. But I still don't think in that context it's helpful to talk about savings. I don't think that the aggregate degree of liquidity in the system depends on savings in any way. I think savings is the wrong term here, and I don't think it captures the thing that is scarce, because your means of payment that are available to you at a given moment to meet your survival constraint are not a function of your individual savings. And the aggregate degree to which units have an easier or harder time meeting their survival constraints is not a function of aggregate saving, which aggregate saving is obviously just the passive accounting flip side of aggregate investment. So, or, in a more realistic context, aggregate investment plus the budget deficit and the trade surplus. So, I agree with the point you are making there. I think it's a very important one. I'm glad you made it because it's something I had intended to say and didn't. But I don't think that bringing the savings concept in there is helpful.
Thank you. Barry, do you want to go next?
Sure. Maybe higher level, more philosophical. I'm very interested that I want to know your thoughts on what is the attraction of where does this fetish of the real come from? Why do people find that so emotionally satisfying? Okay. Or maybe to put it in the opposite way, why is the monetary character of reality so anxiety producing? Why do people, want to not think that way? Okay. And I just want to get you thinking about it. I use the words discipline and elasticity. But you've used both of those concepts in your talk without using those words. In specific, the elasticity is how money facilitates the new, the endogenous money. And of course, that makes people anxious, because the new, I'm not doing the new, I'm doing the old, and this is disrupting my life. And I can see that I don't have any control over it, that AI is just doing its thing, and it's going to disrupt my life. And that's a source of anxiety. I think the discipline part is also, which is what Sasha was mentioning a little bit, that there are some people, most people face a binding survival constraint. That is to say, what the survival constraint does, and now I'm I think just translating what you said into money view language, okay, is to force people to take account of where they are in the larger production system, that they can't just do whatever they want, okay? They have to earn money because they have to pay money, okay? And of course, people don't like that either, right? I really would rather be a subsistence farmer or something, but I can't, I have to take a goddamn job at a factory, So I think that unpacking some of this anxiety about the monetary character of the economy may help to explain the emotional attraction that exists today. It's you put that as if, oh, that's the origin of economics, but it's actually today. There's the fetish of the real is a very serious, and I think a political constraint. And if we are to advocate for change or evolution, I think coming to grips with where that comes from, okay, may be helpful in communicating.
Yeah, I think that's right. I agree with everything you said. I thought about, since our last exchange, I'm still thinking about whether discipline and rigidity, I feel like maybe they're actually expressing slightly different thoughts. So I'm not sure I want to just adopt your language, but I did actually consciously choose the term intermediate degree of flexibility to avoid using either the term discipline or elasticity because of our last exchange. But yes, the fetish of the real, where does it come from? Well, I think you put your finger on one of the big sources of it. I would agree with you that money is a profoundly disruptive force. It is coercive. It is a way of compelling people to contribute their labor and their other, whatever other claims they have, traditionally maybe a claim on a piece of land or something else. to a larger division of labor, which from a long-term social standpoint, we can say is a very helpful thing, but it obviously feels very disruptive and coercive to people who are in that situation. So that's one side, but that doesn't explain the sort of elite discomfort with it, which I think is just as important and is part of, obviously the economics profession reflects. And there, what I think really is the element of choice. I think that what people really are trying to avoid is an acknowledgement that there is a conscious collective choice being made about the organization of the economy. I think that certainly when you look at things like the kind of idea of the natural rate and the associated language that central banks use, this is a very, I think, conscious in some cases, and certainly very deeply rooted effort to present the choices central banks are making as central planners, as conscious decision makers about the direction of economic activity, to present it as simply reflecting something that is already out there, something that is natural, something that is not the product of anybody's choices. I think this idea, I think you can find this going back very far, this deep suspicion of finance, because it allows for people to do things because they've decided to do them, as opposed to because that's just the way they are. And I think, there's a long historical affinity between sort of more critical ideas about money and efforts to consciously reorganize the economy. John Law, has got this reputation of a terrible swindler, helped destroy the French monarchy. But, he wasn't just trying to engage in these crazy financial schemes. He was trying to carry out what we would today call a form of industrial policy for Scotland and then for France. Or, Alexander Hamilton, whose report on manufactures also includes a lot of proposals for, both for expanding the banking system and monetizing, the new federal debt. He thinks it's very important to have an ongoing federal debt because that creates liquidity. He doesn't use that term, but that's the concept. So I think there's a really strong affinity between a more realistic view of money and conscious efforts to reshape the economy. But I think conscious efforts to reshape the economy are very threatening to people. I think in general, and this is maybe from my point of view coming a little more from a Marx influence side of things, but I think for people who are in power or exercise some kind of authority or have some kind of status or privilege, it's much, much more comfortable to say the position I'm in, the way things are organized, is just the way they are. It's just natural. It's just how things have to be, because that's just what we have. We're doing the best we can with the hard constraints we're all subject to. Versus this is society's organized the way it is because somebody in a position of power to do so decided to organize it this way and could have decided to organize it a different way. I think that's the idea at the elite level that's extremely threatening and really drives, in my mind, the attachment to this illusion of a real economy, this fetish of the real.
Just a quick follow-up. That's very helpful, okay? Because and now let me just connect it to what I was saying. So if the elites get away with this, okay, in a democracy because of the things that I was mentioning, right? That individuals have anxiety about the monetary economy, and so they're vulnerable to arguments like this. And so the problem for the left is in fact making people more comfortable with understanding the monetary character, so as to push back against this elite premature closure of alternative futures.
That's exactly, yes, absolutely, 100%. I guess Anush.
Yes, sorry, I was muted. Anush?
Hey, Josh, how are you doing? Good to see you, man.
Hi, it's been a while.
Yeah, thanks for the book. I look forward to going through it properly. So I can't help, and thanks for your presentation, obviously. I can't help but respond to the whole idea of the fetish of the real. And I think it's become fetishized. I think people are concerned with the real because, especially, they're concerned with the wealth of nations, the origin of wealth of nations. Why are you rich and I'm poor? Why are there rich countries and poor countries? This is, in some sense, the kind of birth of social science is concerned with this. I think economics, the fetish of economics is a sort of outgrowth of the classical dichotomy and the downplaying of sort of institutions and politics. And I don't think economists can sort of think institutions properly, and so they sort of and they can't take money properly, therefore, and they sort of, so it's become a fetish, but the fetish is a pathological version of a very underlying solid concern, which is the concern with real wealth and the real sources of wealth and poverty and power. So I don't think we should mistake the fetish for a sort of mature concern, as it were, with the real. In a sense, we have to save the real side from economists. But my question, my question to, and I think I take Josh and Arjun in a sense to be sort of part of that pursuit. So my question to Josh is, in a sense, leading on from Sasha's question. So where does hierarchy come from? Which is sort of, in a sense, my long-term dialogue with Perry, and you know, sort of the down hierarchy balance sheets want to know where does hierarchy come from, right? Anyone can issue money, but the problem is to get it accepted, as we know, Minsky said. So the amazing thing about the hierarchy of the credit system is that it's precisely as Sasha said, what's endogenous at one level is exogenous at the other level, right? The central bank's credit is bank money, is money to banks. The bank credit is money to me, right? So it's a nested hierarchy of endogenous exogenous relations, which is precisely why hierarchy is a clever way to get beyond this exogenous divide that economists have sort of gotten themselves into a muddle over. But this exogeneity, I call it this exogeneity, which is in a sense endogenous to the system, right? The system produces your credit is my money, so this is the source for me of the money fetish. Is that it's precisely, it's a kind of fetish, again, inbuilt into the system. It appears like something exogenous to me, but it is in fact concatenated social relations, right? So the dollar may as well be gold because I can't produce it, right? I have to earn it. So it gives the system a commodity-like feel, even though we know it's not about the system. But this exogeneity emerges from the system to give it a commodity-like feel. In fact, what we are feeling is discipline, right? Because and it's the harshest discipline. Capitalism is a cash nexus. The survival constraint is real. I get liquidity or I die, right? So and that is unique to capitalism as a system. And so the discipline element is very critical. So therefore, how does the productive side enter into this hierarchy, right? How does the productive side enter into the determination of the value of money, if not the price of money? Or put it differently, why do different countries face different survival constraints, right? This is the problem of elasticity and discipline. And lastly, let me absolutely sort of agree with Perry's idea that, you know, once we get over the fetish, we have to think, you know, so discipline is for the elites, elasticity is for the Democrats in a sense, right? It's elasticity for whom? For us, for the down hierarchy balance sheets. Now, of course, you can go to town on that in its own way, but I think that's you know, one of the central lessons here. But unless we have a good account of how you get real elasticity unlocks production, if you like, not running up balance sheets. I don't think we can sort of use this, or we can't come up with good policy or even theoretical proposals on how things work. So I think we do need a way to link up hierarchy with production. I don't know if that's a question or a comment or what, but
well, it's some thoughts I would definitely like to respond to, because they're very interesting and important issues you flag here, which honestly are things I've been struggling with a lot in my own mind. I think, you know, the wealth of nations, I mean, that is what's at stake here ultimately, is what is the role of credit in organizing and transforming real productive activity. You know, there's a passage in Lombard Street that really struck me when I read it, which is, you know, he says, you know, the Suez Canal, you know, shortened traffic, obviously, and you'd think it would have, you know, sea traffic between Europe and the Far East, and you think it would have benefited the countries closest. But in fact, by far the biggest beneficiary was Britain, even though it's, you know, not particularly situated near the canal. And why is this? He says because of the organization of money, that Britain is the only country that had money able to be directed to activities that would actually, you know, benefit from the canal, to be able to expand its trade with the East and expand its ports and so on. And I think it's a really provocative argument that it would be really interesting. And I would love to really see this question. Maybe I'm sure somebody has tried to answer it, but I would really love to get a better handle on it myself. If we're looking historically, what can we say about the relative importance of access to credit in cases like that? If we were going to look, say, at the 19th century and observe the obvious fact that there was extremely uneven development of railroads around the world, how much of that reflects, you know, that there are just higher real returns from building railroads in some places? How much does it reflect some real scarcity of the necessary inputs? And how much does it reflect perhaps the availability of credit or finance for railroad construction in some contexts, but not in others? And I suspect that actually that last factor is very large, maybe decisive, but I would love to see a systematic exploration of that, because you're right. Ultimately, that's what those are the stakes. That's what this.
Those are the stakes.
That's it. So I mean, that's not an answer, but it is, I think, the question that I think we really should be focused on. In terms of where the hierarchy comes from, why are some units facing a hard survival constraint? Why are some units living in a hard money world and others aren't? I think that's also a really interesting question, and not a question with an obvious answer in my mind, but I think there's sort of two kinds of answers that one can give to it. And one is, in some sense, that it is pure convention, or at least largely, in some substantial extent, convention. If we start with the sort of notion that the fundamental atomic unit is a promise that can be accepted, and these promises can get generalized. My promise to you, maybe you can find a way to transfer to a third party who's willing to accept it. If I happen to stand in the middle of a lot of exchange networks, my promises are going to be more generalizable, and this can sort of organically develop into something that looks like a system of money and payments, and people will write contracts in terms of a promise that's been more widely diffused already. You can imagine this as really a kind of system that kind of grows out of a smaller, more localized network of promises, and that it gets established in a particular form really based just on convention and history. And of course, once a convention like that is established, it can be very hard to move, but that doesn't mean that there's anything behind it more than convention. So that's sort of one kind of answer one could give. The other kind of answer one could give is that in some sense, the hard money side, the survival constraint reflects some kind of pre-existing form of social power, some kind of organized public of some kind, whether it's the state. So this, or something state-like. So this is sort of a broad chartalist view without necessarily zeroing in on tax obligations as the thing, but there is some kind of pre-existing form of power that can say you must meet your obligations in this specific form, and that the hierarchy ultimately rests on that. And you know, I mean, I think that if we're looking at historical cases, I think we're definitely going to find cases that seem to fit one of those stories better and cases that seem to fit the other story better. And I would be reluctant to say that, I personally would be reluctant to say that I'm confident that I would give one or the other perspective primacy. I think it's certainly interesting in an international context, as you brought up, because if we're talking about the dollar specifically, is the dollar in some important sense underwritten by U.S. military dominance or the broader U.S. political primacy? Or, you know, people say, oh, well, it's because oil is priced in dollars. I don't know that I really buy that, but some people will tell that kind of story. Or is it a convention that, in theory, with enough, you know, enough disruption could get reestablished in a different form? I don't know. I think personally, I think that is a question on which it is productive to be agnostic and to be open to both possibilities, and to it's something it's I mean, you might say it's a fundamental question. I should have a point of view on it, but I think I don't know. I feel that there's something on both poles. Now, the last point, though, I do want to say, I think in terms of countries lower down in the hierarchy, I think access to foreign exchange is much less important in absolute terms than it's made out to be. I think, you know, there's a very misleading conflation in the term capital flows between, you know, financial claims across borders and access to capital goods. I think is extremely unhelpful and misleading, and it makes portfolio flows seem valuable in a way that I think they're just not. I think a lot of what we see in terms of international finance is basically a swapping of ownership claims across borders. That, from my point of view, the sort of fundamental thing going on with certainly portfolio flows, if you are a wealthy person, family, let's say, in a developing country somewhere in the South, you own, a productive business or area of land, whatever. You would feel much more comfortable if that claim instead was a claim on a bank account in New York or London or somewhere. And that's a more politically secure way to hold your wealth. It's easier to turn wealth in that form into the other things that you want as a member of the, global 1%. And on the other side, it can be attractive for some wealth owner in those places to acquire a claim on a real productive asset in, Egypt or Argentina or wherever. So it's a swap that is beneficial on both sides, but it's not doing anything for the country involved. The country is not a party to it. You can say, well, they're receiving foreign exchange, but for the most part, the demand for foreign exchange comes from the fact that you have foreign obligations that need to be serviced in the first place. So I think even, foreign direct investment, I think it's very clarifying when we keep in mind that the formal definition of foreign direct investment, which is actually the correct one, which is that it's an ownership claim that carries some control over production. So when we say our country needs foreign direct investment, what you actually mean is we need foreigners exercising authority over production processes in our country. And then now sometimes you might think, well, that is a good thing. The only way we can acquire their foreign expertise is if we give them technical expertise, if we give them control of the enterprise. Or the only way we'll be allowed into their distribution networks is if they have control of the enterprise. So maybe, but you should be very clear that you're not getting physical things. You're not getting means of production. FDI is simply a control right that you are trading off to somebody in the rest of the world. And that makes you think, is this? So I think in general, I think that it's been very beneficial for elites in the South as much or more than in the North to allow ownership claims to cross borders extensively. In that wonderful Quinn Slobodian book, Globalists, he talks about this a lot as a sort of self-conscious project of Hayek and that early generation of neoliberal thinkers. So I think when we think about it that way, we say, are you objectively in a situation where you face a hard money constraint because you are low down in the hierarchy? Or is that something that's actually been sort of created by the terms on which you are financially integrated in the rest of the world? And there is, at least in principle, the possibility of severing those ties and loosening the constraint that way. I think we really need to be, I think that from my point of view, you can't really solve a lot of the problems of the South as long as you take the need for foreign exchange and for foreign ownership claims, which is, again, what we really mean by foreign investment, if you take that as a sort of objective hard constraint.
I have to say two things in response, Sasha. Sorry, just very quickly. I know
we're already really late. I'm sorry.
No.
We're 20 minutes late, and we have two more people who would want to say something.
Maybe you and I can continue this.
We can discuss it later. Sure.
I won't even let Alex and Ankit ask their questions because we simply have to go on. But this was extremely useful, and please reach out to Josh via email with comments. We are going to proceed with Pablo, who is also time constrained, and that's also one of the reasons why we can't be more over time. So Pablo, please take it away.
Thank you very much for the invitation. It's a pleasure to see many people here that I know. Anu, Jay, Perry, it's great to see you again. Let me see if I can share the slides. And let me put them in. Do you see it well? In full display, full screen?
Yes.
Right.
Yes.
Some of you, well, again, thanks for the invitation. Some of you may have seen previous presentations a couple of years ago, but now I'm very happy to say that this presentation presents a roundup and very soon to be published work. It's based on this book, which is about to come up in 2 weeks' time, co-written with Nina Kaltenbrunner and Ricardo Dorsey. However, everything I say here is my own responsibility as usual. And it deals with international monetary and financial subordination, so it might touch upon some things mentioned previously. I will try to go somewhat briefly around ways and theories of IMF to focus on the pillars and our definitions and the transformations and some exits for policies. This is the structure of the outline. Please tell me in 20 minutes whether I'm short or long in time.
Okay.
As I say, this is the book that it's about to come up on July the 6th. And what we see, how do we theorize the IMFS, because it's a long phrase? Well, we see it as being reflected in two aspects. One is a cyclical aspect, and one is a structural aspect. The cycle is the typical boom and bust cycle: growth, indebtedness, speculation, increase of risk, a sudden stop because of some reason, a default, a restructuring which cleans balance sheets, and it usually starts again. Now, which country is pushing this factor has changed throughout history. One can identify, let me see, yeah, one can identify such cycles in the 19th century. Here what we clearly see the wave of capital outflows from Britain in the second half of the 16th century. And that's on one graph. The other graph shows episodes of surges of capital inflows after the fall of Bretton Woods. That's the cyclical aspect, but there is also a structural aspect, which consists on who bears the burden of risk and the value transfer. It is usually done, carried, burdened by the debtor. That leads to specific productive and commercial profiles. Sorry for the Spanish in between, related to productive and commercial profiles. And this has been acknowledged at least since Thomas Moon, an author whom I really recommend. How is it instrumented? How does it come to happen? Because of the institutions and networks, mainly in London, but also in the colonies or peripheries for trade and value transfer. There is a great paper by Ingrid Van Graven and Kai Kodenbrock and Sila, I think, on the networks in Senegal and Ghana, and how they relate to their centers, respectively, Paris and London. In the underdeveloped countries, it manifested in the inability to borrow externally in domestic currency, which made, and this links to the previous discussion, foreign currency a requirement for productive investment and infrastructure. Without this foreign currency, be it gold, be it dollars, or being British pounds, productive investment and infrastructure is very, very limited. And actually, in the back of this graph, you can see the coat of arms of the East Indian companies, and it was expressed like it expressed, manifest, and related to Thomas Moon. Of course, he was one of the first chairmen of the company, and it is one manifestation of this subordination of productive profiles to the financial networks that embed it. There are many theories of subordination and dependency: Latin American structuralism, dependency theory. They usually started to focus initially on production dependency, on production subordination. Later on, with María Conceição Tavares, They include this financial dependency. Doing this research for our work, I found a lot of similarities and points in common with Susan Strange when she talks about the power of finance. The literature on currency hierarchies, but as you will see, we move beyond currency hierarchies, and I will explain why. It's very difficult to define what is the IMFS. There was a previous definition in a very interesting paper by Alami, Carolina Alves, and there were 7 authors, including Anina and others. And I define it as a spatial relation of domination, inferiority, and subjugation between different spaces across the world market, expressed in and through money and finance, which penalizes actors in developing economies disproportionately. We propose a compatible but somewhat different definitions. But before doing that, we have to present what are the pillars. And we turn to Minsky, which I think has not been very much used for analyzing open economies. There are many works, of course, but we want to dig further on the theoretical backgrounds and theoretical underpinnings for analyzing open economies and developing countries. First pillar, hierarchical interrelationship of balance sheets, depending on acceptance. That's the first pillar. Minsky was clear that he conceived there is a passage where he says that one can conceive of society as an interrelationship of balance sheets. Second pillar, uncertainty and liquidity. And there comes to, from this point, comes to major propositions. First, liquidity is a feature of the institution, not of the asset itself. That's how we move beyond currency hierarchies and into financial system hierarchies. Second proposition, uncertainty shapes behavior, of course, and institutional arrangements to shift the burden of uncertainty either side of the relationship. Our fourth pillar is that this system is characterized by financial innovation, which gives it an historical and dynamic nature, historically not determined, but influenced and dynamic nature, because new instruments appear, new countries and actors borrow, and I will present you a bit further. I will elaborate a bit further on that. So what we have is a changing, hierarchical, and evolving interrelationship of balance sheets between different agents or changing financial structures. So as I said, there is room for institutional, conventional, historical, and class factors. We found, and I want to thank a referee on that as well, quite a number of writings by Minsky, mainly in the 1980s, on open economy dimensions. And in a couple of them, he explicitly says that he wants to extend the financial instability hypothesis to the open economy. His view comes mostly from the dollar top down, but we did take him as a starting point to explore this, let's call it bottom, the heterogeneities within this bottom, which is our main concern. So if we extend it to the international economy, what we have is a hierarchical interrelationship of balance sheets between agents of different countries in different currencies through different instruments. So this view breaks with what Stefan Murau calls the Westphalian metaphor, or the Island view as the BIS calls it. this interrelationship sets a liquidity and risk premium on the asset at the top, so everybody else has to burden some risk and uncertainty relatively to the asset at the top, which again is backed up by the institution, that is the Fed. These pillars are the pillars that organize transfer of value and the burden of risk. So, come again to our definition. This is our definition of what the international monetary and financial subordination is. It is an external constraint on the autonomous capacity of national authors to create internationally accepted financial assets and liabilities, which in turn influences the creation of domestically accepted assets and liabilities. I will explain a bit more because it may sound, what are they talking about? There are some important elements in this definition. We look both at liabilities and assets. We believe that the focus on assets of developing countries has usually been restricted to reserves and, in some cases, capital flight. But we believe there have been very important transformations on other components. We look at banks and non-banks, not only non-banking financial institutions, but also, in some cases, non-financial corporations as well, that operate across borders. We emphasize the word constraint, not determination, which implies a matter of degree, which is subject to change. We talk about nationality criteria instead of residency, and instead of outside of the elimination or the very weakening of national borders. Nationality still is very, very important. And the last aspect that I want to highlight is the feedback with the domestic creation of assets and liabilities. The external influences the domestic and vice versa. So which are the transformations that we identify? The transformations on the external liability side of developing countries are relatively well known. There is a greater share of portfolio flows, vis-a-vis bank flows, foreign investors in local currency market, we know that. We know that during the 2010s, several banks, non-banks, and non-financial corporations managed to borrow in global markets from corporations from developing countries managed to borrow in global markets. There has been a change as well in who's the creditor with the rise of global asset managers. There have been new and numerous swap lines with major central banks, Brazil, several countries in Asia with the Changmei, even with the US dollar, Korea. Even India became established swap lines with Bhutan and Nepal, I believe. The Gulf countries have swap lines with many countries. So there has been a broadening in the countries involved in swap lines, though I know that the current U.S. administration imposes a great question mark on whether how would these swap lines function in the future. Finally, financial instruments from developing countries have been included in international markets through participation in investment indexes, not only sovereign bonds, but also, for instance, ESG, environmental, social, and government bonds, etc. So there has been an increase and diverse participation of developing countries through their external liability side in international markets. But that is not all. Transformations on the asset side. Well, we know that developing countries after the East Asian crisis started to accumulate reserves as much as I could. And me, as Argentinian, I'm very supportive of that, and if anybody has dollars to supply to this country, we will welcome them quite warmly. But there are also some important changes. First, there has been an increase in portfolio and other investment assets of developing countries. You may think of them as another expression of capital flight. And to some extent, it's true. Other investment assets covers deposit, but they also cover loans. And it's not merely capital flight. This is capital exports. There are new institutions in developing countries, larger by the day, pension funds, sovereign wealth funds, and asset managers as well, and banks. And this is something that I will mention briefly. Not so briefly, actually. I would like your comments on this. Expanding this external asset side, this has attenuated and improved their position in the position of the developing countries involved in these transformations. It has reduced their degree of subordination, but there are some nuances and clarifications that I will make shortly. Obviously, not all countries have experienced these transformations. Some miss them, all of them. Some other experience some of these transformations briefly. Some got worse in terms of their position in the hierarchy. And I'm speaking from one of them, right? Argentina. This is what I said about the persistent expansion of portfolio assets and other investment assets, but I want to concentrate on this graph. This graph shows that several countries have increased the cross-border claims of the residence bank. And we are talking about Brazil, Chile, India, Indonesia, Malaysia, Mexico, South Africa, South Korea, which is we have to split the graph actually. In South Korea, you measure it in the right-hand side of the graph. The case of Turkey, we studied. Turkey experienced fluctuations. We also see that this expansion is actually, there are shams rather than persistent and trend increase. There are shams. Shams in around 2005, 2007, before the crisis. Shams before the taper tantrum. And in some cases, shams around the time of COVID. For instance, the case of Mexico, for instance, the case of South Africa, India. Some have reduced a bit, actually, right before the COVID, the case of Brazil. But what we see is an increase in cross-border claims. I think we take it as a stylish fact, honestly. Bear in mind that we are talking about resident banks and not nationalities, though our argument goes to nationality, and we do have the graph for those countries for which data is available. This graph takes from the data from the locational banking statistics. Nationality is reflected in the consolidated banking statistics, which has data for fewer countries. But for those that there is data, I think Malaysia and Brazil appear there. The trend is also reflected.
We are at 25 minutes, Pablo.
5, excellent. So what we see is that there are new actors, new instruments, new currencies, in the sense that there are currencies of developing countries which are taking a bit of a higher share of global currency trading, new infrastructure. Some agents manage to issue externally accepted liabilities. And some agents manage to issue externally accepted assets. They manage to lend abroad. Now, for banks, and given the audience, I want to spend a bit more of time on this. First point, it is important how they expand internationally, where they do it through branches or subsidiaries. That affects how their capital is exposed. Second, how do they fund this international expansion? They still have to go through the US dollar. So that's why they expanded internationally where global dollar liquidity was abundant. How do they deal with currency exposure? That's a question. These are questions that are worth exploring based on this stylized fact. There are very few articles that deal with this. I can mention one for Colombia. And there is a great article from the BIS in a BIS bulletin some years ago, which looks at the hedging, the foreign exchange hedging that underpins this international expansion, particularly of pension banks in Asia. What is the relationship with the home company? And again, who regulates what? Which central banks regulate the expansion of its banks into other developing countries? We know that, for instance, in Africa, Moroccan, Nigerian, South African banks have expanded abroad. In Latin America, Colombian and Mexican banks have expanded in Central America. Malaysian and Indonesian and Indian banks have expanded in the region and even further beyond. So this is happening. It has been happening for at least 10 to 15 years. It has not been dealt deeply in the literature as I think it should. And it reminded me a lot of all the concerns and discussions that happened during the time of the Concordat, after the fall of Bretton Woods, after Herstatt, Banco Ambrosiano. A lot of the concerns there reappear now, but with an institutional infrastructure, BIS, etc., already in place, unlike 50 years ago. And as I say, there is evidence of jurisdictional arbitrage and regulatory conflict here. I don't want to miss either a mention of social classes. Again, sorry for the Spanish, this autocorrect functions not quite well. Who gets access to international markets? Well, it has been in developing countries. These are mostly commodity-linked non-financial corporations, finance, utilities, communication services. So these are very specific sectors. How does risk interact with cost, income, and debt is something to be explored. And furthermore, the position in the IMF is not set in stone. These transformations have changed, and missing out on these transformations as well has changed the degree of subordination, still subordinated, but not quite as before, of several countries, and increased their policy space. What to make of policies? Well, two mantras. Again, liquidity is an asset of the institution, it's an attribute of the institution, not the asset. And the normal function of the economy depends on the belief that the refinancing of short-term debts will be available. So, what is the role of international reserves? To create, mold, and validate the expectation that payment or refinancing of short-term commitments is available in two senses. Reasonable conditions, interest rates and exchange rates that don't create havoc in balance sheets, and in the sense that the expectations must be validated for all the agents for which the central bank is ultimately responsible, right? In those two senses. Terms, interest rate and exchange rate, and for all the nationals. That's why nationality is still relevant. And that's why we are talking about the financial hierarchy. If expectations are validated, and if you ask me how a rule of thumb number to see if they are validated is to have reserves at around 30% of GDP, then developing countries can, as I say, go in an adventure on the asset side, developing sovereign wealth funds. However, they must acknowledge that this adventure will be unavoidably mediated by the US dollar. And the last point, I think to be right on time, is that validating the expectations that short-term external debt refinancing will be available improves the domestic acceptance and creation of financial assets and liability in domestic currency. It reinforces the expectation that in case of need, there will be a convertibility of domestic currency to internationally accepted means of payments in reasonable terms. And the state might be able to develop a domestic debt market in three senses: not only currency, not only legal jurisdiction, but also with national investors. I stop there. Thank you very much for sharing, for listening, and I welcome all your questions. And
thank you, Pablo. That was great, and great in terms of time. Who wants to go first with comments? Perry?
I'm hogging all the time. Sorry, but this is a very fascinating paper. So my question for you, Pablo, this has added more information, more data points than I knew, but in general, the story of the increasing financial sophistication of the Global South is known to me. My question for you, you don't mention the global financial crisis of 2008-9, and I wonder whether this, and my teaching often I treat that as a pivot point. Maybe that's just a pedagogical device, but it was a pivot. But you're suggesting that this transformation in the Global South actually predates 2008-9, okay, and that whatever came after that was building on a foundation that was already sort of nascent, and maybe it built faster because there was a foundation there already. In particular, when I teach this stuff, I talk about the zero interest rate policy in the Global North, that the financial crisis of 2008-9 was a crisis of the North, right? And so that created space for the Global South to expand into. And we do see at that point the national champions in the Global South are able to tap global capital markets for more or less the first time, although in dollars, as you say. So my question is, maybe to bring into this conversation a little bit, the role of the global financial crisis in enabling, amplifying, accelerating these developments.
Okay. Shall I take a couple more questions, or I reply?
You can also go. And then we can see.
Yes, I think it predates. For me, after looking at the data, the breaking point is the East Asia crisis. From the point of view of developing countries, the change is the East Asian crisis because it killed one expectation of open capital, of the benefits of open capital markets. It implied that even if you do things by the book, money will not be available as needed, and worst of all, you may end up in the hands of the IMF. And everybody wants to avoid the IMF, and you still may want to avoid, I tell you from experience. First point. So yes, it predates it. And it could be articulated with a build-up of the housing bubble in the US. So in the sense, from the push factor, you can look at the 2001 lowering of interest rates. Now, about the specific case of the 2008 crisis, it had an impact. It did have an impact in two senses. One is in terms of magnitude. there has been an increase. The amount of dollar liquidity that flew to developing countries with the quantitative easing was very large. So that's one point of one major thing about magnitude. But there has been another impact in terms of actors. There has been the substitution of banks and with a rising role of investment funds, asset managers. And one can see it in a couple of things. Recall that I say Colombia has expanded in Central America. This is an example. It expanded in Central America because American banks retrenched. And Moroccan banks expanded in Africa because European banks retrenched. However, there is some work by the BIS, which is great again by Sheehan. They are the best people, one of the best people doing this, which says that actually American banks shift markets. Instead of providing loans, they provide swaps. So they are the counterparty side of foreign exchange swaps. And one event, circumstance that reflects this change of activities, of role, it happened during COVID. Right, because American banks withdrew from providing swaps briefly. We are talking about February, March 2020, right? And that forced Asian central banks to draw on the reserves by the hundreds of billions. We are talking around $300 to $500 billion. And partly because they have to provide dollar liquidity to their economy, but also pension funds and investors from their countries that have expanded abroad with hedging from foreign from FX swaps provided mostly by American banks. That is an interesting example of the vulnerabilities that they opened by these new transformations on the asset side. So again, if you ask me about what was the role of the 2008 crisis, magnitude and accelerating change in actors. That is what strikes me about the effects of the 2008 crisis in this story.
Okay, do we have other comments? It's been a long day for us, so I can imagine that by this point the Zoom fatigue is kicking in. Yes, Anush.
I have one quick question for Pablo. Good to see you, Pablo. So, alternative sources of liquidity are often seen as, and often institutional sources of liquidity are seen as the way to mitigate subordination, right? The other sort of traditional way, if you like, and I'd like to get your thoughts on that, is capital controls, or what is now euphemistically called capital account management. That's the sort of kosher term for it that the IMF has given. From the position where you're sitting, and then of course the classic problem here is that it exacerbates the problem in the short run, right? Because if you signal a closing of the door, if it's asymmetric in any way, then in fact it limits your access to liquidity. So you're sort of caught between a rock and a hard place. But so what are your impulses on capital controls as a mitigating strategy to the subordination that you've so nicely outlined?
That's a good question. I will speak for myself here, definitely not for my co-author. So here goes my view. For my view, that I have experienced capital control for the last 15 years, so I know what I'm talking about in this case. They are. I like to have the first, certainly on the inflows. I believe that the best way to prevent outflows is to control the inflows. That's the first point. Second, even in outflows, some are necessary, a few, but they have to be very surgical and to the point, because elites are connected, and they know how to jump outflow capital controls on outflows. They know, and you be chasing a ghost every time. You adjust this, and some other market might destabilize or might appear. Capital outflow controls, they are a measure for crisis time, 6 months. They shouldn't be implemented much more than that. Certainly, capital like macroprudential policies, foreign exchange macroprudential policies for sure. Measures on inflows for sure. Not accepting everybody who wants to come in, and certainly not into some specific markets for sure. But capital outflows measures, they have to be very, very specific, very chirurgical, because you are chasing a ghost, and not only you will not be able to chase him, actually, but while you try to chase this ghost, you end up fucking up something else. Some other problem will appear with another consequence. So sometimes I'm a fanatic of building reserves, even more than me. I'm a fanatic of building up reserves. Complemented with capital inflows and some surgical, like very pointed outflow measures. For instance, one that I like is limiting the turnover of the foreign exchange turnover of pension funds and investment funds. I think that Peru applies that one. And that's very there. There is another about the foreign exchange positions of banks. They are easy to regulate, but the non-banking sector is very complicated.
The last thing is what India did. Thank you so much.
Alex, briefly.
On my unmute button. So this is related to kind of the question you were just asking, but what does your ideal global monetary system look like? What is the optimal level of subordination, and how far are we from it? How do we know? And
how far we are far. Well, optimal. I think that there are two things, which is first, I'm still a Minskian, a Keynesian, right? So easy for me to say something akin to Keynes, but taking into consideration two differences with respect to Keynes. I understand from the point of view that Keynes was writing at the time, but two differences. Countries may need to run current account deficits. They may need to. So it's I understand that Keynes shifted the burden of adjustment to creditors, but there was still implicit some view that you cannot run current account deficits forever. So there has to be acknowledgement of different stages, of different development stages in this financial architecture. And ideally, there should be one. Actually, I come back to this expectation of short-term debt refinancing being available. I think that the financial system must ensure, an optimum would be one that ensures or that validates this expectation without creating moral hazard, but one that also seeks to reduce, to manage these commitments, like on the expectations and the commitments themselves. So it has to be pointed out, it has to be focused on two sides. Perhaps I'm being unfair to Keynes, who also at the same time stimulated a World Bank, right? A World Bank and a global investment fund, basically. So, yeah, for me, it should be a system that works on the expectations and the commitments itself. We are very far away from that, and it would be interesting to see how China. There won't be any global initiative for this, so I'm not kidding myself. This is a non-topic for international system. It's just something for academics. But it would be interesting to see what China comes up in the next 10 years, at least.
Okay, thank you, Pablo. That was great. We are now going to move to our panel. So we have a panel that's going to include Jay Pocklington and Alex Howlett. So Jay is going to talk to us about the stablecoin PAR and MICA compliance, and Alex will talk about payments being natural and pre-political constraints of the monetary system. I think 15 minutes each, and then we'll have a discussion. Jay, you can start.
Well, thanks. I'm glad you're all here because you're the people I would like to talk to about this. Let me see. I hope you can see my slides well. To preface, so just so everybody's updated, this is the first draft of my first paper in my PhD that I'm doing under Sevaston and
Share it maybe for the whole screen.
Yeah, let me try this. You can see it?
I think it got smaller for me. I don't know how it is about others.
Got smaller for me too. It looks like a vertical. Okay, there we go. Oh, but you're not presenting anymore.
And now maybe if you share, I think it's going to be good.
Does this work like this?
Yeah, this is good enough. Yeah, absolutely.
Okay. Anyway, okay, so the overall topic of my thesis is to take on stablecoin from a European perspective. So Europe being a peripheral actor, and you can see from the title that I've taken a money view concept in PAR and tried to analyze stablecoins and the very strong promise, which is PAR, from a perspective that we're all familiar with. So thanks for sticking around. So to preface one conclusion that we're familiar with is that PAR is not inherent in any is not inherent in the balance sheet of the issuer of the stable coin, but it is what I call an infrastructure achievement, and that sort of mirrors what we heard earlier in various discussions. So just I think we can see that here. So let me just give you a sense of what I'm doing here. Europe is worried about stablecoins because look at the denomination of the market's composition. We have 99% stablecoins denominated in US dollars, and Europe composes 0.4%. There are sovereignty concerns. There are concerns about platform lock-in and so forth, but I won't get into that, just to give you some sense of the scale. But the research question that underlines the paper is how Europe can regulate US dollar stable coin, to what degree MICA is adequate. MICA being the regulatory framework markets in crypto assets. That's what MICA stands for. Let me see. Now I'm having trouble getting to the next slides. You guys can see. Okay, so I'm relying on 4 literatures for the paper. One is, of course, Moneyview Vanilla, which is Perry's MOOC and framework, but then also Perry has written specific stablecoin paper that was a BIS working paper but has become published since last 2024, and that is entitled On Par, and he analyzes the same par relationship and relates stablecoins to the phenomena of Eurodollars. There's an interesting spin-off that I really build on, which is from the MIT Digital Currency Initiative, or an Up and Company, and they basically point to the fact that stablecoin plumbing is really what we have to pay attention to. So how things get redeemed lower down, and that's really the point I'm making here too. I'm building on that. How does the promise really get redeemed, and to what degree? Even if Europe complies, we find the compliance of stablecoins. To what degree do we rely on actors and infrastructure that lie outside of the European regulatory framework? And furthermore, legal texts, MICA, DORA, and company, we have various frameworks there, and then the monetary sovereignty literature. So these are the literatures I rely on. But I'd like to get to this. The hook that I used in the previous presentation was that the solvency view is not enough. Obviously, we know that. I don't have to make the point, but the Silicon Valley story tells it very simply that even if we have a fully compliant, fully solvent actor, as in Circle over the weekend of March 2023, some news broke and some concerns were there, and there was a weekend which led to the fact that par broke. So we have a fully solvent, but doubts about liquidity. So that just should be a pointer to why we can't just look at the issuer being solvent. We have to look at the infrastructure in which solvent liquidity is achieved in the case of an event. So that's just the hook I have. So here, for those of you who are not familiar with stablecoin, this is just the map. I take this from the Digital Currency Initiative from a blog post they have. At the center, we see the stablecoin issuer. They take money from institutional clients and give in return a minted stablecoin, and they use that fiat money that they've received and invested in safe liquid assets, typically U.S. government bills of short-term nature. Now that's where all the institutional relationships are between the institutional clients who have to redeem the stablecoin with the issuer. And then those stablecoins are traded on secondary markets, which 99% of us would then interact with Binance and company. And that's where par actually broke, because the retail investors don't actually have a direct rail to the stablecoin issuer. They have to go through the institutional client, and there's a layer here. And so that's just a secondary market, and that's where the example I used earlier, that's where the par broke, and we need in those markets, we need speculators who do an arbitrage exercise to bring it back to par, right? If par goes down, they have an incentive of actually redeeming it for $1 one stable coin. They're the ones, and that's when there was some doubt about what happens further left on the chain. That's where that's why it didn't trade at par over that weekend. That's just an example. So we can just say there's 3 stress mechanisms that we could point to. My example now is about the first. Assets are there, but the direct cash access is in doubt. That's the first one. The thing I'm going to focus on right now in this paper is the second one, which is the actual reserve monetization. And that if stablecoins are sold, they have to be sold into markets. So that's an obvious point for us here. And then there's obviously the other point that the secondary markets needs actors conducting arbitrage for the par to be maintained. So we have 3 different mechanisms that we can look at here. What am I? Yeah, so I have a balance sheet example, but I think it shows simply that the redemption of a stable coin needs to be done or will rely on the treasury market. That's just the example I'm using here. So coming to the European perspective, so what am I interested here in in the paper, which is we're taking Circle as the example. Circle is a US dollar, USDC is a US dollar based fiat stablecoin, and it is now come under compliance with MICA. What does this compliance entail? And the question I'm asking, what exactly do we achieve in Europe by making it compliant? And the short answer is that we regulate the issuer. We regulate the reserves. We regulate where those reserves are held. So the quality, the supposed liquidity of the reserves, where they're held, and a number of these types of things. But what we don't regulate is the underlying infrastructure in which the reserves need to be liquidated, and those are global markets. So that's a simple point. Obviously, everybody here, but reserve monetization, arbitrage, or market makers, and dealer liquidity and repo markets are not in European jurisdiction. That's the first point. And the second point I make in the paper is that we have a second layer that is problematic from a European perspective, where we don't regulate well, or we cannot reach it from a regulatory perspective. That is, stablecoins are, of course, an on-chain representation of a dollar. And this on-chain settlement also is not fully within the reach of the regulator. What happens on-chain cannot be easily regulated. But that's true for the United States as well as Europe. So that's a symmetric. I call this a symmetric problem across the board. But the asymmetric problem is that if there's a stress event in US dollar stablecoin, we require a US dollar backstop, quite simply. That's the conclusion of this analysis. There's a second regulatory framework, which is DORA. I'm just going to skip that for this purpose, but that regulates the ICT angle, which is what systems are we using. And since this is all digital money, we have to be worried about the underlying systems from a technology perspective, just as much as we have to be worried about the mechanisms. So the point here is that we regulate the issuer. We have created safeguards on this front, and there's a lot that falls outside of this, outside of the direct European control. So that's what my analysis concludes. Let me just see where we are, and I make a controlled comparison to show how this works. So we take on the left-hand column a non-European economic area USDC, which is the global circulating stablecoin. We have a global issuer, which is Global Circle LLC. We've now, if we move right, we've now made this a claim that's with a European entity. So we've localized the claim with Circle France. And now you have a legal claim to receive par legally within the European framework. There are specific European requirements for what the reserve composition is, which actually differs from the global. I'll get to that in a moment, why that is problematic. And the final point is that reserve monetization, if we need to liquidate the treasury bills and other assets, we need to monetize them in markets that are non-European, that are not regulated within Europe, and that ultimately require a US dollar backstop if there's a problem in those. And then the final problem is, of course, that we have what's called a dual issuer problem. If we have these two coins circulating on the same blockchain, the blockchain itself, and that's a point that Closer, Monet, and another co-author make, and that's something that the white paper of MICA USDC also reveals, is that the blockchain cannot distinguish between a regulated European USDC and a non-regulated American or global USDC. So it's indistinguishable But if you were to redeem them, you would have to have different off-ramps. You have to go through Europe, where there's different regulatory requirement, different reserve composition. So that's an underlying issue within this framework. So this dual issuer problem. I won't explore that further here, but that's obviously so. Just showing the obvious point that market liquidity is essential. That's the point that the Digital Currency Initiative also makes. We can't just take for granted that just because we have what in normal times is a liquid instrument, that in a problematic sense, when market liquidity dries up or there's some sort of other issue, that getting an asset and getting cash are not guaranteed. So you have to rely on the infrastructure being functional. The one thing that I do here in this controlled comparison is to change the currency, which is the same issuer. A Circle of France also issues a European denominated stablecoin. So if we go down the list there, we also have everything localized. The reserve monetization happens in the euro area because the assets are traded in the eurozone. There we have another issue that emerges, is that the liquidity is very thin in those markets. So that we might have a different type of issue, but we don't have the denomination issue, which is it's in euro, so this lack of liquidity could be potentially backstopped. Neither of these coins in MICA are get any formal backstop by the European Central Bank. So there's no formal backstop guarantee at the moment. So that's what this controlled comparison does. And basically, the obvious point is there that I've already made, is that PAR is an institutional achievement that relies on a long chain of interactions and institutions, part of which fall outside of the European regulatory oversight. And of course, we are not able to fully backstop liquidation into markets that are trading in dollars. That's the obvious point. So the evidence I use is the white paper itself. This is when compliance is made. The issuers have to provide a white paper, and they provide these points themselves. So it's not something I have to sort of dig up. They themselves acknowledge that they cannot maintain PAR independently of the functioning of markets. So they acknowledge that in their own white paper. So to conclude, what this paper shows is that we have on the right-hand side an asymmetric issue, which is Europe is dealing in a currency it cannot backstop directly. And then on the settlement layer, we're dealing with on-chain settlement that I didn't explore in this presentation in any detail, but on-chain, that's a point that Shin makes. You require validators of transactions that need to be paid. So there's a form of liquidity that emerges on-chain that can also not be regulated. And plus, there are other issues on-chain that lead to fragmentation, and the singleness of money is probably not adhered to as stablecoins scale. Since I'm here, this sounds like a very simple paper, and it is. I had to narrow it down to something that's actually an obvious point to me and an obvious point to everybody here. But that's something that I now have backed up with a methodology and evidence. But what this paper will feed into a series of papers that I'm working on in the PhD. I'll just quickly run you through it so you have the overview. First paper you just heard, which is what is the regulatory reach and how is PAR maintained? And to what degree does this PAR maintenance, even of compliant European stablecoins, rely on infrastructure that is non-European and is global in nature? So that's the paper one. Paper three will analyze on-chain liquidity. So I don't get confused. This is the second most important paper in the thing. Paper two I'll get to in a moment. But paper three looks at Shin's claim that I just mentioned, because validation on-chain is expensive, and as more activity occurs, he predicts that there will be fragmentation on-chain, so that you would move into multiple blockchains, therefore creating also different liquidity on different blockchains, even for the same stablecoin. So this point I'm going to test in that paper. So I'm just going to see, as this fragmentation happens, I will test the hypothesis that's analogous to the FX markets, in which, when there's many different sort of pools, small pools, fragmented pools, you will only build infrastructure to the biggest liquidity pool, not to all other pools. So that in FX markets means that you route your FX transactions through the dollar, because capital allocations and investments for market makers and FX traders are not going to be made with every single currency pair, but only with the dollar or the biggest ones. So my claim, first of all, is to see how is liquidity on-chain emerging. First point, if Shin's point is correct that we have fragmented liquidity, the second point to test is here. How does this fragmentation of liquidity lead to an on-chain hierarchy? So Tether and Circle becoming vehicle sort of stable coins for the rest of the ecosystem. That's the test I will be running to sort of test. And that's a problem for Europe also, and I'll just explain why, because the hypothesis here is also that all the good stuff that we're getting from stablecoin, programmability, which means we can do smart contracts and everything else, that requires sufficient demand and investment on, and you have to decide which stable coins you're going to do this in. You're going to have to decide in which, where you apply. I'm assuming right now, I'm not fully clear if that's true, but it might be the case that a lot of the more sophisticated and capital intensive applications of stablecoin will only be done in the most deeply liquid stablecoins, the most deeply used stablecoins, and therefore even European stablecoins, if they were to emerge, but they don't have liquidity as they don't have right now, they will just be routing to a large degree into those bigger stablecoins, those more liquid stablecoins. That's the second hypothesis I'm going to test. To see, and I will be doing interviews there to sort of see what the current thinking is of various actors, to see if those hypotheses hold up. But that's the third paper. Second is sort of testing the European, or evaluating the European alternatives. Those are tokenized assets, obviously, European Euro stablecoin, and Project Agora, which is sort of this project led by VAS of creating on-chain ecosystem for 70 plus actors currently, which is probably an interesting project. So I'm just going to analyze to what degree, from a European perspective, we will achieve all the benefits of stablecoin without the dependency structure on the US dollar, and maybe a better setup that retains the banking structure that we know, compared to this this bifurcated stablecoin environment that is currently emerging. And the fourth paper will ask the question, will other factors like platform adoption be determining which digital money, which tokenized money will scale? So for example, if Amazon or Google decide to become actors here by acquisition or creating their own stablecoin, they have a immediate impact on which type of stablecoin or digital money might become the dominant force. And that's something that papers have come out right now to warn about. But it's not about what is the best system, but it's also about this dual interaction of network effects on the platform end, together with early adoption, which is already happening in dollar stablecoin, and the European alternatives are just coming late. A digital euro, which I forgot to mention in paper 2, is only getting adopted in 3 or so years, right? So this is a long time from now before we can see that there's an alternative in place, and obviously we have lock-in effects and so forth. So that's the kind of where I am. I just wanted to leave it there. But sorry, I was now 20 minutes. Sorry, that's it. So takeaway, the final point is MICA compliance changes the legal geography of the stablecoin claim, but it does not change the market geography of par maintenance. So that's the point that I'm making.
Okay.
I'll leave it there. Thank you, guys.
Thank you. Thank you. Let's go immediately with Alex, and then we'll comment on this very briefly.
Hey guys, so I'm not going to do slides. I'm just going to talk for a little bit. So what I want to talk about is kind of this question that I raised when Josh Mason was here, which is what are the constraints on money that can't change? You know, what are the constraints that are kind of natural and exist regardless of kind of what your politics are? I remember I was talking to Jay at an event, YSI event in New York City back in 2022, I think it was, and we were talking about how, you know what, the money view doesn't really have an opinion about what's at the top of the hierarchy. You know, what is the monetary standard made of? Is it gold? Is it something issued by the central bank? Blah 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 blah. And does that mean that it doesn't have a theory of that? Or by not having an opinion, is that saying something? Is that saying that whatever's at the top of the hierarchy has to be whatever works in order to facilitate all of the stuff we talk about in the money view? We have a general means of payment. We face liquidity constraints. You know, there's banking, you know, expanding balance sheets on both sides, you know, all of that stuff. You could imagine trying to poorly engineer a monetary system in such a way that stuff doesn't work anymore. But then you wouldn't be solving the problem that money solves anymore, which is to have a general means of payment in the economy, a generally accepted means of payment, to settle debts. So are there, you know, different monetary theorists define money in different ways? Are there better and worse definitions of money? And I would say, yes, there are better and worse definitions of money. If I go to, you know, Ben and Jerry's ice cream and I say, okay, I'm going to define money to be the thing that people use to buy ice cream at Ben and Jerry's. Am I going to end up with a theory of money? Or am I going to end up with a theory of their, you know, loyalty points, flavor fanatics inside scoop program where you earn points and you can get free ice cream? Well, it depends on what I'm looking at. If I'm looking at someone claiming ice cream with their free points, then I'm going to come up with a theory of that. And that's a theory of something, but it's not a theory of kind of the stuff we're interested in here. And the analogy here, of course, is Chartalism, right? Is Knapp, right? He has a theory of money that is, you know, money is a tax credit. It's whatever the government accepts in its public pay offices. And if you go and look at Knapp, he actually says in there, in his writing, that there are privately circulating means of payment, but they don't count as money unless they're accepted in the public pay office. Like, well, I don't want a theory of some weird thing that the government accepts in taxes. I want a theory of, you know, you could come up with a theory of that, but it's not useful, you know, if we want to understand a theory of the general settlement medium. So I like the analogy of money and language because they are both social coordination technologies. And they're both solving, you know, kind of problems, and there are constraints on what they can be. So, you know, people sometimes say, you know, money is inherently political. Okay, that's fine. You can say that. But if you're going to say that, are you going to say, is language inherently political? Okay, yeah, it is. I mean, it's, you know, there are official languages of governments and, you know, they tend to kind of correspond with states and, you know, there's official documents and, you know, in the appropriate languages and, you know, which language you choose has political implications and, you know, all of that. Right. Same thing for money. Maybe the monetary system is managed more directly, right? Tends to be by governments. Does it have to be? No, you can have a merchant money, right? In medieval times, you can have you know, silver and gold that are kind of, you know, Locke emphasized this, right? We read in the Money View reading group, we started back in 2021. The third book we read was Chris Dizon's Making Money, right? And she talks about how money is a constitutional project. It's an inherently political thing. And in there, she talks about Locke as this kind of I don't know, he's wrong or something, right? He's kind of like the villain of the story. He's trying to say that money is, faces constraints that are outside the state, and she's saying no. But even reading it and seeing him framed as a villain, I kind of with my money view background, I was thinking to myself, he sounds, like I don't think he's necessarily right that it has to be metal or something like that. Is if he's even saying that, he's living in a world where it is, right? That's the international money. Um, but he's right that there's, something natural about money, and there are constraints that you can't really change that are outside of the control of anything political, right? The government is maybe the best person to manage money. The state is maybe the best person to manage money. So maybe it's a creature of the state in that sense. But there are ways of doing it correctly, and there are ways of doing it incorrectly. I like what Perry says about money being infrastructure, right? It's infrastructure for the economy. And bridges are infrastructure, right? And are bridges political? Well, sure. The government is going to decide maybe where the bridges should be built or something like that. But there are ways to engineer and construct bridges incorrectly, such that they fail, such that they collapse. And the same thing is true of money. Hold on, I have some electricians coming in. Yeah, no, you're fine. Okay. So I think this is a useful question for us, and it shouldn't be ignored, right? And this is why I wanted to ask Josh Mason this question, because sometimes people who want to emphasize the political aspects of money make it sound like it's this, like it's a human invention. Okay, maybe, but the wheel is a human invention, and if you go to an alien planet, they're going to have wheels too, because it's naturally like an efficient way to like, is technology something you discover, or is it something that's inherently human? I think it's both. And I think if you go to an alien planet, they're going to have money, and it's going to follow, the at least the basic rules of kind of, discipline and elasticity, making payments, survival constraint, all of that, right? Maybe the specific structure of the institutions, they can vary, just like different people can speak different languages, but languages, everybody has to kind of, has to have, vocabulary and grammar and syntax, and you have to all be on the same page. It's coordination, all of that. So there's some things that are natural and true about money, and payments are natural. Liquidity constraints are natural. And I think it's worth asking what's the best definition of money, and not saying like, okay, if you're defining money as inside scoop points at Ben and Jerry's, then you can do that, but you're just not talking about the same thing that we're talking about here. And I think most monetary theorists, even Knapp, when they are trying to come up with a theory for money, they're seeing a means of payment out in the world, and they want to try to understand that thing. And sometimes they just define it in a way that prevents them from having a theory of the actual thing that they want to understand. And that's one of the things that I really like about the money view, that it doesn't have an opinion about what's at the top of the hierarchy, except that it has to be something that works, right? Something that can be, the means of payment. It can be the base of a hierarchy of where the means of payment is down below. Sometimes Perry, there's a quote from you in one of the lectures, Perry, where you're talking about how maybe the top of the hierarchy, it's so vanishingly small, gold is maybe even in the mind or something like that. Well, in economics, prices are set at the margin, and the margin is vanishingly small, and par is with respect to the top of the hierarchy. So even if the size of the top of the hierarchy, in terms of like the amount of it out there, is vanishingly small, it could even be zero. That doesn't mean that it's not critically important, and I think it is. But it's not important that it's gold. It's not important that it's issued by a central bank necessarily, or it be cryptocurrency. What are the constraints on CBDC and cryptocurrency, like to kind of to speak to Jay's paper that he's working on, right? If we want them to be money, then there's certain rules we have to follow. Like cryptocurrency doesn't get around any of this, right? CBDC doesn't get around any of this. So maybe it gets around some other things. Like maybe we put in, capital controls and artificial constraints, and CBDC or cryptocurrency can get around, ways in which we've maybe engineered our management of the monetary system poorly or something like that. But we could probably engineer it better without that stuff too. But maybe maybe cryptocurrency is the motivation for that. So I just kind of wanted to talk about this. I started writing a paper about it, but I'm interested in people's thoughts. I'm interested in pushback, especially, I was, Jan Toporowski, Joe Michel, we've got, or at least earlier today, we had some non-money view heterodox folks, maybe thinking about labor, full employment, and money's role in certain other things. I just kind of like, is there kind of like a way in which we can kind of all come together on kind of this fundamental thing, and it ties into kind of, because we're talking about the monetary standard, it ties into monetary stability and price level, which I'm often kind of harping on, and I think there are constraints there, right? Because if you have a monetary standard, if the top of the hierarchy, if the purchasing power is bouncing all over the place, you can't have a payment standard based on that. It just doesn't work. But maybe there's some flexibility, and there is. So yeah, I just want to bring that up, and I hope it gets people asking questions.
Thank you, Alex. Okay, we can open for comments. Okay, Perry.
So I will start. I seem to be the designated starter. My question is for Jay. You mentioned this little paper that I wrote with Dan Nielsen and Iñaki Aldasoro, in which we were analogizing the stablecoin to the Eurodollar. And part of that analogy I want to push on and ask you about right now, which, because you don't mention it, that we observe that the par in the cash market between the offshore market and the onshore market is basically protected by non-par in the forward market. That the Eurodollar rate of interest can rise above the domestic rate of interest, and that sort of keeps the money in place. Okay. Now, some of that emerged sort of organically from the earlier fact that the Eurodollar market was built on time deposits, so that banks knew exactly when they were going to have a cash outflow and when they were going to have a cash inflow. Okay. And then there was a forward market that naturally arose because you could create synthetic forwards from these time deposits from different times. So my question, is there anything like that? It sounds like MICA is not about that. It's trying to find a way to ensure par settlement in the cash market by holding lots of reserves or something like that, rather than by just holding this stuff in place. But is there any forward market emerging? And if so, would the regulatory apparatus, allow that, approve of that? I think that is where robust defense of par is possible, as opposed to loading yourself up with reserves. So that just based on the analogy with the Eurodollar market.
Yeah, I mean the first, you can hear me, right? So I have not seen an analysis that makes any similar point to the forward markets anywhere else so far. But I've also, I'm new to stablecoins, so it's not something that in fact, this is something we're going to talk to Izabella about, because she's much deeper in all the news that's emerging here. The point that I am simply making is that is a dependency point, right? A subordination point, if you want to call it this, which is that that even with a very strict compliance regime, which MICA is putting on, and you have Circle, which is willfully complying with Europe in trying to establish this. So one thing I didn't mention is Tether cannot be traded officially in Europe. They're off the exchanges. So if you're not MICA compliant, you cannot be legally traded within Europe. So this is now a legally compliant best case scenario, right? We're talking about an issuer that's fully complying with all the wishes, is completely transparent, has good reserves, everything's as we hope. And still, if you go down the entire chain, that's where I follow Aronoff and the MIT Digital Currency Initiative, You go down that chain, and basically, yes, you can make people hold those deposits in European banks to make in European institutions, which makes the claim strong. So that's what MICA is about. It makes the legal claim very strong within Europe, enforceable. But in order for that claim to be actually delivered upon, you need to sell those assets into markets. And the question is, what are those markets? So that's the emphasis. What I'm putting forward here. And so it's simply applying a simple liquidity analysis onto this whole MICA framework. The question is where do we need liquidity? Where is it coming from? If in the credit, we're not worried about it on everyday. We're talking about stress, right? When a stress event happens, how are you going to sell? And there's more issues that are emerging. I already mentioned that it's not completely clear on chain. You don't have a homogeneous reserve requirement for all stable coins that are the same issuer globally. So that's going to create some issues. I'm not sure exactly what that means in detail. But the point of this paper is not how Europe actually maintains par in an infrastructure sense or liquidity sense in which we think about it, which is obvious, which is markets. How do you have market makers? How do you have a backstop, or how do you have guarantees, or how do you force a cash flow in your way if you need to? It's simply about making the legal claim strong with the issuer, so you actually can make it very enforceable, which is not as strong in the US case. It's looser, but it doesn't say much, or it punts on the question of how liquidity is provided for the underlying assets that are in the reserves. And the thing I didn't talk about was the European Commission has just started 3 weeks ago a open call for a public feedback on MICA, and so they want feedback from the public about how it's going and what issues they see. And I think we could write them a nice letter pointing out a number of points, right? I think we can talk more about the forward markets. I think that's absolutely right. I think there's more things about stablecoin that are interesting, but the more I think about it, the more you're actually making it a proper conventional banking system, right? A lot more features that look a lot more compared to the system we know compared to it being simply a very flat system where there's simply an asset and you can issue something on the other end. So that's where I am. I mean, there's 2 points that are there in this paper. One is solvency is not the right perspective for this problem, so we should get away from the solvency perspective and adopt a liquidity perspective. It's there, everybody talks about it, but they talk about it also in it being inherent in the balance sheet to some degree, which is liquidity is a property of the underlying asset. So a treasury bill is liquid, and that's true in most cases, but not in the cases where you really need it to be, potentially. And if that happens, how do you backstop it? How do you regulate that? That's another point to sort of say. So I take the money viewpoint that par is a market outcome. It's a price. It's a market outcome, and you cannot assume it to be present as a property of the underlying asset you're making. So that's another point I'm making. So and then the question is what is the regulatory reach for that infrastructure for Europe? That's the point of this paper. It's not in Europe. We don't have the reach into that infrastructure to guarantee par for the coins that are issued within the Eurozone because they depend on infrastructure outside. It's not a big point. I don't think it's a major. I don't think I would sound the alarm bell, but it's just a conceptual point that I'm making in the paper.
Can I make a comment, Jay? I feel like what we discussed earlier on when you were starting this work is still something I'm curious about, and I feel would be useful here to understand, because it's still like, even if we understand relatively well the kind of the mechanics of the balance sheets behind creation of stable issuance or stable coins, or defending of par and cashing out and so on, I guess still the question that I would find better in terms of like approaching these exact questions on, you know, how will the market look like, and, you know, how will the internal dynamic of the stablecoin payments and holdings work like, would be to have these questions asked with the kind of understanding of what this asset represents really, right? Like who cares for stablecoin and why, right? Like it's, I guess, like, you know, there is obviously a lot to the way that the market will work that has to do with its balance sheet mechanics in terms of like design of the balance sheet mechanics. But there is a lot to it that has to do with who is going to be holding this and trading in this and for what exact reasons, right? Like if we think of the way that Eurodollar market grew and has developed, we can exactly answer that question, right? We know exactly why Eurodollar exists and why it developed, right? So I guess the you know, is that going to be a same kind of explanation that we are going to have for stablecoin? Is there going to be a different explanation? Is it going to have to do with specific kind of balance sheet or tech mechanics behind it that make it attractive for particular types of entities? And then, you know, given that, you know, how does that play out across different kinds of like liquidity circumstances or global financial circumstances and so on? I still feel it's treated as a black box in a sense, right? While it's really an outcome of a set of relationships and interactions of particular entities with particular interests.
Yeah, I think it's a critical question. First point, from the European perspective, there's no cause for immediate alarm. This is not going to replace the euro. This is not going to be a mainstream means of payment right away. So that's why this paper doesn't make a big deal. It's simply analyzing the conceptual point that you know, you care about financial stability from a European perspective, but you lose now on two. I only focused on the reserve with the conventional monetary part, which we all know, which is the reserve monetization. That is something that you don't have full control over. These are global markets. These are not European markets. Simple point. There's a second layer, which is the settlement itself happens on chain. And that's another thing you can directly control. So now, if you were to imagine a world where, and this is not just a European problem, but a global problem, which is if you were to imagine a fully scaling of this as a payment system, you're replacing all the regulated and backstopped entities with something that at multiple levels now cedes control over the settlement and the backstopping of the reserve assets into some other market that you don't have direct control over. So, and that's different from the Eurodollar market because now you don't have direct control of the entities and the infrastructure anymore. So it's a discussion about which infrastructure, and stablecoins take away local infrastructure. So it's not about denomination only, it's also about the entire infrastructure being partially or fully outside of the European or any jurisdiction, right? And that includes the US, because the on-chain stuff is not even fully, it's not clarified because you don't have an entity that corresponds to the regulation. So that's another point of the paper. You don't have corresponding entities. So there's 2 points where I'm making the regulatory point. One, markets, you cannot regulate a market if it's not in your control because you don't have a counterparty directly to regulate. That's the first point. And the second point, on-chain, it's even worse. Right? On-chain, you cannot regulate a counterparty. It's the validators that are there or not there to validate a transaction, but there's stuff that can happen on-chain that's still to be analyzed what can happen, but a lot of stuff can happen there that doesn't have a regulatory body properly there to correspond to this. So there's question marks there. So that's the point. I think liquidity issues are paramount everywhere, and I think that's what the third paper is really about, because the fragmentation problem that will emerge. So let me restate that again, because I think it's critical for us to understand. Shin says that if and when stablecoins scale, which they're currently, everybody says they're scaling, the scaling process will not happen with big liquidity pools emerging in exactly the same way that we know in conventional monetary systems, but rather because as there's more traffic within this particular blockchain, it becomes very expensive to settle within that blockchain. So the validation needs to be paid, and that's not something that's easy. So that's, according to Shin, he predicts that there will be fragmentation. So you go off into another blockchain. So for that fragmentation, you now need to have bridges between different blockchains, and that's a liquidity operation to go from one to another. Just like on and off chain, you have to have between chain liquidity, and those are market makers or bridges that have to be. That's a liquidity operation. So there's a lot of more places this thing can break. So that's something I'm very interested in from a liquidity perspective, from money view perspective, how that will emerge and how that will be from a regulatory perspective also approached. And there's a whole swath of other questions that emerge from this insight. The prediction is that this will lead to a couple of very dominant stablecoins that have established themselves, and that's the thing there. Because I'll leave that point there. The second point to your question, Sasha, is why do we even need it, or why do we care about stablecoin? What does it offer?
Particularly does.
Yeah.
I mean, I don't.
Yeah.
Right? I don't hold.
Yeah, exactly. So the key defining thing about stablecoin is part of a broader tokenization movement. Tokenized assets are on chain and therefore programmable, which means we can create smart contracts and conditionality, which means no human has to approve a payment, so stuff will happen. So that's important for a number of reasons, but all the AI payment applications will be relying on some sort of tokenized. At least that's one worry that AI native payments will be using that smart payment, because machine to machine requires an on-chain sort of programmable smart contract that allows you to do something. I'm sure it can be built outside without the smart contract, but then you still need all these institutional layers that sort of enable that application, which is a lot more complicated and costly. So, and then the prediction right now is when and how do the big platforms come in, right? When does Amazon and Google, what the winners do they choose, and whatever they make as a default stablecoin or tokenized asset, that will then determine where the liquidity pools are, that will determine where people go, where all the infrastructure is being built. So that's the big worry, and that's what I'm analyzing in paper 4. It's not necessarily what's the best system. It's really like from a when the big actors move, what system are they going to choose, right? And it can happen from a public perspective, like in Brazil, you had PIX just implemented before things were there. You had PIX, and it's great. It's not a stable coin, but it was sort of put into place, and it's there, and it works perfectly. But it's not. In a European perspective, it's very difficult to make a very strong public option. The digital euro is being discussed, but it's going to be a very supplemental option. It's not going to be a very comprehensive option, because you have a lot of private interests and banks who also want to earn here. So they're trying to implement that. So that leads to another form of fragmentation, which then probably seeds the entire space to the US dollar stable coins and the big actors in that way too, because you don't achieve big liquidity pools by fragmenting yourself that way.
Right. Alex?
Yeah, so I'll echo Sasha in saying that I don't really care about stablecoins or cryptocurrency or blockchain either. But I also don't see why AI can't use the same infrastructure we use. And you said there are no entities to regulate, but we had gold as our money at one point, and even though it wasn't issued as a liability by anyone, there were plenty of entities to regulate, or maybe the necessary entities emerged as part of that system. Do you imagine that somehow, if the stablecoin system matures, that the entities to regulate won't kind of emerge also?
Yeah, I mean, that was a strong point. I think literally on-chain is hard to regulate, but you can obviously the on and off ramp you can regulate. You can make a lot of contingencies there. And it's pretty hard to understand because I'm not interested in regulation that much either. But I think there's we will have to go through a long process of figuring out how to bring this into compliance, right? So why was stablecoin interesting? Because it was cheap, right? Cheap, fast, 24/7. That was in cross-border, right? And that's better than this slow, expensive SWIFT system, right? This correspondent banking system. But what stablecoin doesn't do is all the compliance work that these other institutions do. So you still need a bank on both ends or some other regulated entity to make that compliance work, and then the cost differential might not be there anymore, right? So once we regulate all this, I think all these costs will be internalized. Right now, you're sort of cherry picking the cheapest part. Anything that you can do on the same quote unquote balance sheet is cheap and can be done very cheaply, which is like if you stay within the same chain, within the same stable coin, you have a very cheap transaction. But as soon as you go on and off, it's expensive. As soon as you go to different jurisdiction, it's expensive. And you have a lot of fishy stuff going on crypto. So the regulation will have to come, and it will come. And to check all that will be expensive. And so I don't think we're going to have a much better system. Meanwhile, everybody else is catching up. So the future is tokenized forms of money. So the alternatives are CBDC. Of course, they're there. You will most likely have tokenized bank deposits. So you'll have the same benefits of programmable money, but you retain the same known structure that we already have. So banks will probably go into the space, and then you will have central banks. And the thing we didn't talk about, but what Project Agora talks about, is that a lot of the markets themselves will be tokenized, so tokenized assets. So all these things will be on the same blockchains. That's what Project Agora is all about. And they have a successful test 3 weeks ago, so technically everything's working. So it's coming. So this will be how we do it. I don't think it's going to change fundamentally. I think once it's all said and done, everything will look very similar to what we're doing, with additional technology enabling us to do something else at the programmable smart contract level. That's my prediction. But before we get there, there's a lot of havoc that's going to come, because there will be first movers, a lot of Wild West, and catching up and clawing back market share after it's been there, I think, is difficult, right? So it's also a timing question, and who's going out there earning money first, and who's deciding? Is it the Europeans deciding themselves what the best tokenized asset is, tokenized form of money, or is Amazon? Amazon is already paying in stablecoin their creators, for example, right? So it's already happening. They're experimenting. It's not something that's sort of trivial. It's already a matter of time. And I think I can show you. There's a report that came out 2 weeks ago that speaks to that danger. And so that there's a matter of degree, right? To what degree? And then we have sort of patching together of these different systems. Interoperability is another question. How do these different tokenized systems interact with each other, right? That's not a trivial question at all. So all these bridge functions that have to happen between all these blockchains are yet to be built. These are all liquidity operations. There will be a lot of crises there. So we need to fully understand the technology and the balance sheets that are underlying these phenomena.
So why are you predicting that this is the future? What I mean, a tokenized, everything's tokenized. At what point did you go from, okay, there are these people doing this quirky thing with technology that's trying to be about money, to oh, this actually is the future. Wow. Was there something that convinced you?
There's obviously a huge hype. There's a huge commercial interest. I don't think stablecoins is the future per se, but I think there's a lot in this technology space that is interesting. So I think that the AI boom is just starting in terms of the actual commercialization of AI, because right now we don't have that much commerce on AI native platforms. So I think there's going to be a switch, and if that happens, either it might not be necessary, but it's you'll have, just like fintechs emerge, you have stablecoins emerging or tokenized money emerging as a quote unquote solution for a new form of adoption, right? So it will come because people believe in it and people are just there. I think there's other ways of organizing this and doing this. I don't think you need all this stuff, but it's definitely coming and it's going to be present. I don't think it's going to be taking everything over. But the BIS itself and the digital euro has been a huge thing. Like everybody's talking about a response. So somebody has to respond to this phenomena that's there, and the question is, what is this response? How is it all going to settle, and how does it all get figured out? So, and I think I'm only talking about Europe. So, Danqing, you're obviously in this space. I think in China, and there's a huge debate as well. And I think stablecoin adoption in Asia is actually much higher than in Europe. I think in Southeast Asia, it's the highest adoption rate.
Let's hear Danqing quickly, and then we're gonna move to the conversation with Izabella.
Yeah, I have a specific point regarding in Jay's presentation about the settlement layer, which is on blockchain, which is a technology which is outside the scope of the regulated any regulator because it's a public blockchain. From the perspective of the payment service provider, say a stablecoin issuer is a payment provider, then it is as if this provider has outsourced its ledger technology to a third party, which is a non-entity, which is non-legal entity, which is a public blockchain. So it rather than having its own ledger technology in its own data center, keeping the records, it has chosen a technology which is public blockchain. So in some sense, it is this issuer, this payment service provider that's still responsible for having chosen this technology provider. If something goes wrong in there, the settlement doesn't work, then it falls back to the issuer who needs to have either a backup plan, they have a second copy of the ledger somewhere, or they have a paper version of everything. Whichever way, they need to figure out. It's their responsibility to figure out how the ledger is kept. This comes from actually a personal experience back many years ago, when we were dealing actually with a major bank, a bank who says if they are to use the blockchain technology provided by us. At that time, it was Ant Group providing the ledger technology to a third party, which to a bank, a commercial bank. Then the bank says we have to check you. We have to sort you to make sure you are a compliant third party vendor. In terms of it's like the bank is using our technology and we are considered a vendor. So same thing goes if the bank goes to a public blockchain. I think within their internal compliance, they're going to check that this is a compliant third-party technology vendor. That's it.
Okay, I think now we can move to our conversation between Jay Pocklington and Izabella Kaminska. Izabella, welcome. And yeah, Jay, take it away. Maybe you can start.
Yeah, thank you, Izabella, for joining us. Izabella, you've been around this group for a while, but for those of you who don't know, she maintains an outlet called The Peg, which directly deals with the stablecoin issue we just raised and the blind spot. And I just presented a first version of my paper about what MICA compliance does for USDC. And the point, just for you, just so you have the background, is that it regulates the issuer, but it does not regulate the infrastructure. So it doesn't. You still rely. You bring the claim. You make the claim stronger with the issuer. You localize the assets, but the assets will still need to be sold into global markets, which you don't have direct control over. So that's what I trace in paper one. So that's what we just discussed. So since you've been in the space much longer than I have, I think and there's been a lot of questions that I was trying to field, but I wasn't able to. Let me just quickly highlight for you. I've been digging into your blog. These it's not a blog, but it's an outlet. The peg of these last couple of days, and let me just quickly make sure I have it here. So I think I have like 4 or 5 themes that I think you've established, and you can then pick up and give us what the lay of the land is currently, so we can get started. So one is the dollar stablecoins are instruments of U.S. Monetary hegemony. So Genius Act and so forth being and Governor Miran basically having an interview with you, basically being very overt about that this is an extension of U.S. dollar dominance. That's the first point. Then Europe is scrambling for alternatives, both Europe and UK, figuring out what do we do in response. Europe, obviously, with the digital euro. UK, you've been reporting that there are plans for a pound-based stablecoin alternative. Third is the same point I just made. I think you make a claim. I wish I had read this earlier, but I think you make a similar claim to me, which is that the infrastructure layer more than the reserves or the issuer itself. So the infrastructure and the rails are super critical, yeah, of course, we are all reading the same people, the BIS and everybody else who are making those underlying points for us. Then I would say we talk about regulation and sovereignty competition. I think that's a theme. And then I would maybe ask you to start maybe on this last point, which is we both read the Shin paper about the fragmentation phenomena that seems to be occurring. So the signal of money not being there. So the fragmentation being a feature, not a bug. So we might have stablecoin adoption, but it will not be looking like money the way we know it. And I think I didn't read it carefully, but I think you had an interview with Russell Napier, and it's entitled "The Coming Bifurcation of the Monetary System," which makes a broader point. I'm not sure if it directly speaks to the on-chain fragmentation that Shin makes, or if this speaks to a broader monetary phenomenon. Maybe we should take that as an entry, and then you can sort of walk us through what you think is currently going on.
I mean, there's so much going on. My main reflection is that I think the hottest topic in central banking academia circles the last 2 years has been stablecoins. It's like the most exciting thing everyone is looking at, which means there's a lot of output to read on my part. I mean, yeah, I mean, today we've had the BIS put out its latest report. I just did a little podcast on that, just reflecting on the fact that I don't think there's much new in the overview that they've provided. They've just drilled into some of the points they've been making continuously about the singleness of money. But I did think it was quite interesting, like touching on the Napier argument. So I mean, he has a much grander thesis, which is focused on how, you know, both China and the West are massively over leveraged, and Russell sort of thinks that inevitably this is going to lead to financial repression and capital controls. And China's kind of more equipped to do that in some ways because it already has a 2-tier monetary market. But he was sort of speculating to what degree might stablecoins create this onshore offshore effect. And I thought it was quite interesting today in the BIS paper. It's the first time I had seen it. Maybe some other academic has already touched upon this, but they had a nice chart showing, excuse me, showing the degree to which sort of interest rates in crypto stroke stablecoin lending markets are totally detached from monetary policy rates at the Fed. And, you know, there's still obviously some pass through, but it's like totally uncorrelated. And they put it down to kind of like the fact that stablecoin lending rates are a function of their own of the kind of you know, crypto ecosystem fundamentals themselves, whether it's interestingly, they did mention leverage, which is one of the things that I haven't yet written my piece on this. I really want to. I'm still kind of assembling all the information, but hang on. My daughter is just screaming, but it's fine. She's gone. So I'm trying to kind of assemble, some sort of, or create some sort of synthesized analysis of the degree to which leverage influences these rates. And it's interesting they mentioned that. But the bifurcation element is really not so much onshore, offshore. It's what I would call on-ramp versus off-ramp, because obviously for me, it's like second coming of Eurodollars. This is very boring. I've said this millions of times, but Eurodollars were obviously geographically compartmentalized. Whereas here, the point, I think, is that these lending rates are about crypto native fundamentals relative to conventional fiat markets, and they can be onshore or offshore. So if you're lending on via Coinbase stuff, you're influenced by the DeFi market rate more so than the monetary policy rate of the Fed. It's only when you on ramp into real dollars that the variables converge, right, into, well, you get that was it CIP, right? Perry will know what I mean. Was it
Harvard interest parity?
That's it. That's the one I'm talking about. So anyway, I always forget it. But anyway, so I thought that was really interesting. And Russell kind of hints of this because of the fact that, he just sees bifurcation as inevitable and the return of capital controls. And is this to some degree a sort of soft capital control? I thought it was really interesting what you said about MICA, because my impression on that is also the Eurosystem just didn't see it coming. They've created a regulatory environment that completely missed that extra dimension to it. So they've controlled the issuers, but belatedly they've realized that they have no control over sort of multi-issuer coins and the fungibility factor cross-border. And so I think at least when I was still running around at Politico, the impression I got was that there's going to be a second coming of that regulation to deal with that, because it's not something they're happy about. And my general overview, my impression is that the ECB is definitely doubling down on a anti-stablecoin sort of position relative to the Bank of England. Obviously, yesterday we had the Bank of England finally release its framework for sterling-denominated stablecoins, and they've watered down the initial proposal massively after lots of industry feedback that was, very angry at what they were proposing, £20,000 depositor caps and things like that. So they've totally reversed on it, and and they're showing that they're listening. That said, my impression is that BOE is still very keen to. It still wants to prioritize tokenized deposits over stablecoins, but it doesn't want to look like it's anti-innovation. So it's pushed ahead with a very lenient relative to the Eurosystem regulatory framework. And I think also the doubling down, I mean, we've seen Izabella, Christine keeps slamming stable coins, and Isabel Schnabel most recently has been also slamming them in the context of also the idea of the euro becoming more of an international currency. I thought it was quite interesting that, the criticism isn't just about whether digital euro is better than a stable coin, because obviously there's this huge consortium called Kivalis, which has absorbed all the different I can't remember, there's more than 20 banks now involved in that consortium. And I think the narrative has sort of shifted a little bit at the ECB, which is that they're anti-stable coins, not just because of interoperability issues. You have to differentiate the technology from from the other aspects of what's going on and dollarization. They're very explicit now about the dollarization risk, whereas I don't think they were even 2 years ago, year and a half ago. And now, like what I picked up most recently, there's this idea that the dollar, it's not a question of the euro not having to sort of, well, what was it? Let me just remember. So the dollarization was always about, the euro has just as much of a right to ascend to global hegemonic sort of levels. And now it's about kind of competition in between. It's all about monetary sovereignty and becoming kind of resilient to these evil US forces that are trying to constrain Europe and create dependencies that it doesn't want. So there's this like strategic autonomy element to it now as well, which I think is really fascinating. So that's like an overview, but I can talk about so many things. So which direction would you like to go in?
If you allow me to have one-on-one with you later this week, because I have many questions regarding my own PhD, because that might not be in the public interest, because I have very specific questions. I think we can also let the audience ask more general questions about what's going on, because I think let's talk about the regulatory frameworks which kickstarted this a little bit, because the narrative is a little bit that the Genius Act and MICA in the US environment started sort of a broader adoption boom, and now there is the discussion about the Clarity Act. Could you give us a quick overview about what exactly these regulatory frameworks have done, and what we're expecting from the Clarity Act that is still being discussed right now?
So obviously Genius sort of set the parameters of what was to be expected, but there's all these loopholes. And I remember, when Genius first came out, I was really confused as to why Christine Lagarde was still like incredibly fearful of US dollar stablecoins coming for the Euro's lunch from an interest rate competition perspective, because she kept sort of referencing in meetings that they could sort of steal, euro depositors. And I was like, yeah, but they're not allowed to pay interest. And so, she was well ahead of the curve on this, because actually what she was referring to was the third party, the capacity for third parties to generate interest through wrappers and like tokenized MMFs and as in money market funds and all sorts of like rewards and these synthetic interest rates that were being applied by third parties. And obviously Clarity is all about trying to establish boundaries on that front. And the banks are, I presume you guys already know a lot of this, but the banks are obviously outraged that the stablecoins should, they don't think stablecoins should be allowed to offer interest to depositors, because that's coming into their turf. And if they are doing that, they should be regulated as banks, and they're not, they don't have to be capitalized to the same degree. So they see it as a very unfair and uneven playing field. And I think in recent days, they supposedly came to some sort of consensus that, the stablecoin side saw as a victory on their part. But I don't think I think it's still ongoing. There's still ongoing kind of, the banks haven't given up just yet. And the real issue, I think, is in terms of how these third parties get regulated. And then again, in the BIS report today, I thought it was quite interesting that they home in on these third party platforms, and they say, they highlight that to some degrees they are issuing dollar-like liabilities and without the necessary capital buffers, which I think is a nod at that. They don't really expand on it, but I think I understood it as a sort of acknowledgement that Coinbase, etc., when you have an account at Coinbase, you don't own the underlying crypto directly. You are holding a liability of Coinbase. which is how we got to the FTX disaster, because they can do all sorts of things in the background, and they aren't regulated in the same way. And we don't even know to what degree. And based on reporting, I know from what I hear on the ground that there's a lot more risk taking and a lot more sort of market making and that they're taking principle. That they're basically putting their own balance sheet at risk and to create liquidity and to facilitate redemptions when needs be. It's very murky. I can't find it. It's very difficult to kind of actually figure out to what degree they're doing that through their filings. But word on the ground is that and they run quite substantial OTC desks, and they're shorting and giving, and that's one of the reasons they can afford, I think, to give interest to depositors, because they are doing all sorts of things. Not to suggest it's, I mean, I don't want to libel anyone, but I would like to see more transparency on that side, and I do think the banks have probably got a point. So I don't know if that answered your question. I mean, Clarity Act itself, I think, is the other interesting element of Genius is in terms of the waterfalls in insolvency and the degree to which depositors, like in the event that banks issue their own stable coins, how much of a priority will stablecoin holders have in terms of rights to the underlying liquidity or assets over conventional depositors. And I think that is now, like, belatedly, I think people are realizing that changes the scope of resolution in a more fundamental way than people appreciated. But that's in the event that banks become massive issuers of stable coins.
Great. A very quick follow-up to just complete the regulatory question. MICA, the European Commission, has asked for feedback last month. Do you have any idea how this public consultation will be used and what kind of updates they might be making to MICA? Do you have any insights in that?
I don't know, but I heard on the ground that Teva now has 2 lobbyists in Brussels, whereas they didn't really have a presence there before. Circle has always had a big presence. Sorry, I've just dropped my mic. So Circle were like incredibly active on the lobbying side, but it's only very recently that Teva's not got 1 but 2 lobbyists there. So I suspect that's an indicator of what's coming. And I guess they will also have there's a lot of lobbying going on from the Cavalis consortium, presumably, as well. And because I do think the comments from Schnabel and from Lagarde were really quite critical, not openly critical, but they were a sort of backhanded sort of stab at Cavalis. And given that to some degree there were sort of noises earlier this year that maybe stablecoins should be part of like the strategy that the ECB uses to help internationalize the euro, that was coming more from the Germans. I think it's an interesting about turn. There's obviously, I know for a fact that the Cavalis people have been kind of invited a number of times to give presentations to the regulators there. So, and they were very hopeful that they'd be included in a kind of wider internationalization of the euro vision, but it looks very much like that's not going to happen now. So I think you're right. I think now is just, it's going to be like a lobbying free-for-all. There's going to be some sort of revision, and I suspect it's going to, I mean, my impression, I'd be interested to hear what you think, actually. My impression is that they're going to actually just try and close off these fungibility loopholes rather than open things up.
Yeah, I mean, in the interest of everybody who's here, so the fungibility issue, if you didn't catch it from my presentation, is that the same stablecoin under different regulatory regimes, it can't be distinguished. That's the point that the white paper reveals of USDC MICA compliance. So we have the same Circle coin circulating on a blockchain, and apparently the blockchain cannot distinguish between the two. And so there's also different. I'm not exactly sure what that actually means, but in practice, if it gets redeemed, it has to be routed into completely different off-ramps. That's one issue, of course. And the question is, what do you do about it? Because the only thing that my perspective is that you have to homogenize the regulatory environment, just like you have with the Basel regulations, but that's not going to happen because on-chain. Yeah.
I mean, my impression, but again, like this is just from talking to people, is that it's more that they're fearful that their really prudent banking, regulatory environment, and their, like the European system's just going to be full of these because they're so much more conservative. They're going to have like nicely, properly sort of backed stable coins with lovely liquid bank deposits. And the fungibility issue is that, like, if you hold a Circle coin issued in the US rather than in the euro, you could, in a stress situation, go and redeem against this lovely pool of liquidity that the Europeans have amassed, draining all their hard work and effectively funneling it to lower light touch jurisdictions. So they basically end up kind of underwriting the rest of the system. So if the US has a more spurious regulatory environment or a less conservative one, they effectively get to have their cake and eat it, because they benefit from their depositors will be able to just drain liquidity out of the eurozone. Is that kind of what you've heard?
Well, I'm trying to talk to you because you're the ears on the ground. I'm just reading your stuff, so I'm just.
I mean, that's what the ECB originally said to me, that this is their main concern, is just the regulatory arbitrage.
That makes a lot of sense. I think there's obviously a number of concerns, but there's also a lot of things that can go wrong when you don't know where you're routing the payment. Obviously, once the smart contract is executing, for example, you don't know where it's routing until the actual redemption is requested. So I'll just restate two questions that came to my presentation, which is about why would we need stablecoin in the first place? What is exactly the use case that might be emerging? So in the second, I think just a preface is like, what are the big tech platforms thinking and doing in the background? Because I'm not sure if you saw, but there was this German Finanzwende, so the German version of Finance Watch, published a report sort of warning of the fact that once these big tech companies move in, they might determine which one of these digital monies will be the main will get the necessary adoption within the Eurozone, and then we might be stuck with it or not. So it's a timing question and it's a sequencing question. But I wasn't able to answer that question very well, but to what degree is it true that AI native payment applications require tokenized versions of money? Is that true? Are we really stuck with this type of new phenomena of tokenized money in the future? Is it in 10 years' time, that's where all the money will be sitting? Or is it a niche phenomena? What's your take currently?
I mean, this is a real rabbit hole. I mean, so AI, I don't know if you've noticed, but like they were projecting loads of growth in stablecoins, and it's actually plateaued in recent months. So some people are saying that's because there's a lot more velocity, and that velocity is coming from AI and agents, right? Because they're so busy doing agentic transactions. So you haven't had to have the growth in the base as much because you've just got this agentic element. I don't know if that's true. I think personally, I think it's plateaued because in the last few months we've had very high-profile confiscations of Teva in Maduro's case and in Iran, and it sent a very strong signal that these stable coins are not out of reach of authorities at all. I think it's more of a Euroclear effect, but perhaps some agentic element has also influenced that. I mean, the rabbit hole is very, very deep. If you go at the extreme end of the rabbit hole are people who think, AI itself has gone back in time and created stable coins just so it can amass global resources and take over the world. I'm not even joking. That is a thing that is going around. I think the head of Binance believes that. So that's one side of it. On the other side, in terms of practical, I mean, the real fight is between tokenized deposits and stable coins. And I think the only advantage that stable coins have for agentic versus tokenized is that you can have bots without identities trading stable coins, right? So there's no constraint on who owns a stablecoin because it's literally just any you can automate and create a wallet with unhosted wallet without any need to give up any identity. So it can be an economic force in its own right. This is where the kind of Skynet element comes in. That's what I would call it, because there's no constraint. Tokenized deposits at the end of the day are KYC AML. So in theory, you can't really, Mr. Robot can't open an account to the same degree, or at least they have to open it in the name of a human that is responsible for, like in Singapore where expats can have house workers, but they're responsible for them. That's a terrible analogy, but there is, I think, a limitation. Whereas I think on the stablecoin, so that's why I think the AI, economy is quite partial to stablecoins because it just allows for unconstrained proliferation. I mean, there are some really crazy stories about AIs starting, OnlyFans avatar-based accounts and just drawing, lots of income from gullible, Americans or Westerners, and then using those funds to speculate. I mean, it's kind of crazy. And now, of course, you've got in Hyperliquid and all these DeFi platforms the capacity to speculate through perpetuals on almost any equity. So you can have some. Again, this comes into whether those platforms are a price discovery mechanism or if they're more, tail. Is it wagging the tail? You know what I mean? Dog wagging tail wagging dog situation. But I mean that's I don't think there's any specific kind of reason why technically they have to be stable coins. I think they can be tokenized.
Yeah, I mean that was the point I was trying to raise. I think the fact that it's tokenized is the key, so that it's programmable, but not necessarily stablecoin. Stablecoin is actually, my personal read is that it's a very bad version of the tokenized version because you strip, like you said, a lot of compliance away, and that's why you make it cheaper, or you give you cherry pick what we have in the current system, take the cheapest parts. But once you regulate it and you bring it into a proper mainstream way, then it will look a lot like what we have already, and it will be similarly expensive, I'm sure. So there's no reason to not go to tokenized deposits. But the point is, tokenized deposits in this case would be required for a lot of these use cases that you talked about, right? If AI adopts, do we need that, or can we somehow work around M2M? So machine to machine, of course, needs tokenization, I think, but otherwise you have to sort of construct something that works with the ledger some other input. I'm not sure how it would work, but that's the read from the on the street that tokenized deposits are required for this next generation of AI native applications.
Yeah, and I guess that's the, and again, it's all about the degree of autonomy you give these constructs. I don't know what you would call them, and whether they are economic agents that are ultimately under the control of humans or not. It all gets very deeply philosophical, but it's like, to me, it's astounding how quickly the innovation is happening. It's really very, like, I can't keep up with it myself. We're now at I don't know if that's a marker of us being in the singularity or something, but it's quite incredible the speed with which these innovations are happening and the degree to which I think they are also creating, I think there's second layers of credit coming out of it as well. So, and leverage. So I mean, this is like a whole new area of risk when you get some sort of financial crisis that is, initiated by a bunch of bots without any domicile. So I don't know how you even, I don't know which lender of last resort deals with that.
Yeah, I mean, that's the lens I'm going to be taking also to sort of understand. There's a lot of, as you already said, interoperability. A lot of these bridges, a lot of fragmentation will require a lot of difficult liquidity provisions between these different blockchains on and off ramp, and they're already failing without a lot of stress. So there's a lot of failure potentially in the system, and yeah, we'll see how it goes. So I'm skeptical that this can scale. Also, based on the Shin paper, the Shin contribution before he left the BIS, the last thing he wrote was to basically make the claim that the singleness of money is not respected. So if it scales and if it does scale, we'll have a very fragmented ecosystem, and the fragmentation will require liquidity bridges and interoperability to be even stronger, which it doesn't by design work well. But I'm not sure what your take is on that specific issue.
I just think it's paradoxical. The whole point of this was to decentralize the system, but if you then have to have, because the big new game in town is interoperability solutions, so then you just end up what I call the kind of the ring to rule them all effect. There always has to be, I mean, this is all hierarchy of money stuff, so no surprises there, but eventually, you have to have some sort of central node between these elements, or you expend a lot of and money on pre-funding and collateral, and I don't see how you can have your cake and eat it without otherwise, if it's not through centralization through some other node or an extra layer, and continuous iterations of centralization and decentralization, you have to otherwise depend on, say, the emergence of mega market makers who then just become dominant rentiers in that market, which then undermines the entire narrative for crypto, which was we want to be our own bank, and be freed of the intermediaries. So there's always, I just think it's all kind of paradoxical, but I think
you just stated the thesis, the question that I'm posing for my third paper, which is that if you have fragmentation, you have to gravitate towards a liquidity pool. It's either, my thesis is one of two possibilities. Either you have an on-chain liquidity pool, like the dominant stablecoins will become the liquidity pools for other small fragmented stablecoins, or you go to off-chain liquidity pools to route, because as you said, you need some centralized actor to and that reestablishes hierarchy, right? That's the point. We're going to have a reemergence of a hierarchy framework one way or another, and I'll try to test that in a paper to see what exactly I can find. But the point is that monetary systems gravitate towards some sort of hierarchical structure, and we're seeing it potentially emerging in front of us already. But I see a lot of questions. But comment on that, please. Yeah, but we go to the questions next. Izzy, go for the comment.
No, I think that's nicely summed up. So I'm happy to take questions.
Yeah, I see a discussion. I think let's just open it up to anybody who wants to come in. We're a small enough group now.
I mean, one other thought I had that is percolating around in my head regarding clarity is to what degree I've called it conscious recoupling of stable. So if the original selling point of stable coins was that you could unbundle credit float from payment float and create sort of I guess for risk related reasons, so you don't get that cross contamination that brought us to 2008, right? I think Clarity Act is moving us in a direction of what I would call conscious recoupling of credit flow and payment flow on the basis that, so that was one of the conditions, I think, in the last iteration of the Clarity Act, was that we can maybe allow for interest by third parties, providing it is directed to depositors or beneficiaries who have consciously, agreed to lend their money, right? So this is why it's different to sort of unconscious depositor flows, because the bigger, you guys know better than me, it's like people don't know they're lending money when they have deposits. So this conscious element, I think, was a key point, and I wonder if that is that's an endless kettle of fish, because how do you determine to what degree are people aware of what they're doing? I don't know. That was my final thought, but I'm happy to take any other questions. I think the only other thing that is on my radar is just the slow migration away from stable coins over to gold tokens, which has been a story that's been slow in coming for, we've heard about gold tokenization for a while, but there seems suddenly to be a lot of activity on that front. And I wonder if that's largely because the illusion that Teva was a really kind of unconstrained actor, not subject to the Treasury's diktats, has been punctured, and now there is a sort of demand for an alternative tokenized asset that still has some sort of stability, but is more out of reach of the regulatory authorities. And so what I've become quite interested in is the degree to which, say, Switzerland is now at the center of this new emerging market for gold tokenized transactions.
Mm-hmm. I want to have a quick word, and maybe Anushna, and then we proceed with Paris, because we want to be on time. Thank you, Izabella. This was really, really interesting. I wanted to hear what you think, and this relates to this last comment that you made somehow about RWAs, so real world assets, right? So this has been a kind of a big notion, especially in Hong Kong. I live like Danqing in China, so we kind of look at that side of the market more. And this seems to be similar kind of motivation to what you described for gold, right? So kind of giving like the blockchain assets somehow some grounding in something that creates cash flow unrelated to the internal blockchain kind of dynamic, and hopefully that kind of becomes more convincing or stable or attractive. Yeah, just that.
I mean, I think that's the big new thing. That's the big thing that everyone is pushing. But as I discovered looking into gold, it all comes down to the jurisdictions and the treatment of property rights and how these assets are controlled. So I think, again, as is often the case, the tech community sort of thinks applying just technological solutions is enough to add value and wealth and efficiency, but they don't really focus on the underlying legal structures and the risk of political intervention in some of these markets. And so anything attached to real world assets is as only as good as the jurisdiction where those assets reside. And in the case of gold, that seemingly seems to be, there seems to be mounting consensus that that's going to be Switzerland. And I had not really appreciated until very recently that, because I was under the impression that like the days of Swiss bank secrecy were over. But actually, I didn't appreciate that those regulations don't apply to their bullion business at all. And so 70-80% of all global gold refining happens in Switzerland. It's like one of the biggest contributors to their net exports, and it's entirely secretive, just as secretive as before. But now, the thing that constrained it for years is that it was tied to physical, physical mobility of gold, whereas now with tokenization, it really stands to become a challenger, I think, because it can generate liquidity in an entirely new way, or rather velocity. And I think this is the thing that Teva is now betting on. And I think that they're not yet there, but that's what's coming. I'm a bit more skeptical of more, again, if it's a sort of conventional equity or whatever, when you look at like there are so many different ways of doing it, but it's very difficult. So if you like, when it's a liquid, if there's no price discovery, the question is like, where do you get the rate from? How do you determine, how do you determine the value and price discovery of these things? And there's so much dependency. I think I'm not a techie at all, but I think there's a lot of dependency on oracles, and there's a lot of room for manipulating those oracles. So I'm cautious. I'm a bit skeptical that it can take off with great scale until people deal with the underlying factors that address the fact that it's a liquid for a reason. I don't think it's a magic bullet, is what I'm trying to say. What do you think?
I mean, I'm not sure. I just I'm looking at it from specifically the way in which there has been this interest to attract Chinese investors Chinese developers to issue these RWAs in Hong Kong. And obviously Chinese real estate market is in a going through a difficult time for a while now, and still in a difficult time. And so now this becomes, and it seems that what has been allowed, which is quite interesting because of the really, really tough stance on anything crypto or blockchain related in China, that there has been a kind of channel opened by the regulators in China for the money to come in if the Chinese developers want to kind of tokenize real estate assets onshore in Hong Kong and attract funding that way.
But I think is that like, to me that sounds like if they're open to it, it's because they ultimately control the chair, like they control the environment because they want the money, but they don't want to lose control. And ultimately, the issue is related to control. Like that's why property rights, it's fundamentally to do with property rights and whether
So I would say the first bit of context that's interesting there is that it doesn't work the other way around. They didn't allow for money to flow out into Hong Kong from mainland on that basis, far from it. And that doesn't seem to ever going to be a thing. And the other thing is, why would they do so? They would potentially do so because they understand the difficulty of the real estate sector. And they are very happy if the sector can attract additional capital inflows through these means, and if this can be kind of a minor constrained reality, which is not going to have any financial instability repercussions, then that's okay.
Yeah,
that's how
exactly.
Yeah.
That would be my impression. And are they tokenizing it on a sort of like on a unit basis, or on a like how are they, what
No,
increments of what's the idea behind like how much you can invest in?
Yeah, it's there have only been a couple of cases in Hong Kong of Hong Kongese property like tokenized over there, and there was one initiative to start with one Chinese asset, and that's still ongoing. So we need to see how that's exactly going to look like when it comes true, if it comes true. But from what I understand, it's basically pooling real estate assets into one token, and then it depends like who is issuing, right? But basically, if you're a developer and you have multiple real estate assets in a location, you can kind of structure the token kind of to draw on cash flows from multiple different kinds of real estate assets, whether commercial or not, of whether leasing or selling and so on. So you can kind of structure it and kind of give a sense to the investor of what kind of cash flow they are looking towards to get from that.
Interesting. I mean, it's different, but reminds me of another complex engineering that led to a lot of cash flow into dubious real estate markets.
Yeah, the way I see it right now, it's kind of comparable to REITs, right? So
yes,
real estate investment trusts, which is also a kind of pooling type of thing. Yeah, obviously, for it to be what like mortgage-backed securities were, there is an additional step to how the liquidity would need to work in that market. Probably they're not going to take that step, but sure, there is like a securitization piece to it, in a way.
Definitely worth keeping an eye on. I think it's fascinating. Definitely one of the areas I don't know enough about. So my impression is that I would watch for like any asymmetry in the terms and conditions.
Yeah.
But yeah.
Anush, do you want to jump in for a second? Okay, or we just go.
We can just move on. I'll just say by way of comment, thank you, Izabella, for your insight. It's just remarkable how, I don't know if this is sort of good faith putzing around of computer scientists trying to reinvent 500 years of banking. It seems like that on the one hand, or on the other hand, if it's entirely cynical and they know precisely what they're doing, and this is all just sort of so much kind of, but yeah, I sort of fear it both ways. But yeah, let me just leave it there. Thanks.
They don't know what they're doing. Fair enough. Well, thank you for having me, and by all means, get in touch. And if you want me to probe anything, I'm available to probe. So let me know.
Thank you.
Thank you so much for joining us.
I'm gonna pop off now because I have to deal with my daughter. But thank you so much. Take care. Bye.
Ciao.
All right, and finally we get to the last and very much expected bit by everyone. So Perry, you can start if you want to share your screen or however you want to do it. Okay, wait, we need to unmute you. Okay.
Okay, you're hearing me?
Yes, if you can make it bigger, that would be great.
Yes. This is blocking me here. I can do it from here. Okay, there we go. Yes?
Yes.
So when Sasha asked me to speak, and then he said, well, what do you want to speak about? So I'm still trying to think about making a transition from the money view to macroeconomics, to production, to consumption, to GDP, to employment, and all of that. And I made a stab at that. Maybe you remember in the Money Views Symposium. And this is sort of a different stab, looking at the varieties of liquidity experience in different kinds of agents, different kinds of countries, and so forth. It's a sort of joke on the varieties of religious experience, famous book. And of course, the liquidity system is like one of those elephants where you touch it and it seems like a different thing depending on where you are in the system. And macroeconomics means sort of all of those different points of view are correct, okay, on their own, but you need to get a picture of the elephant as a whole by adding them up. And so that's what I'm going to try to poke at today a little bit. This is part of the book. Let me just tell you what I've been doing with the book, just as a little update. I'm putting my update as the first slide, not the last slide, as Jay did. Book reviews. I wrote a book review of Martin Koenig's book. I wrote a book review of which is basically the talk I gave at the Money View Symposium. So, and I'll be doing one. Somebody published a book in IPE that I've been, and so I'm trying to think about the bridges to other disciplines that are and point out how the Money View might be able to help you. But all of this is an attempt to move toward a money view of macroeconomics and monetary policy, which requires, thinking about the variety of agents, the variety of financial instruments, the variety of interfaces with the global system, and yet all of these various, institutional specificities all come together, in common settlement, basically every day. And that's what gives the system its coherence and its organization and its typical kind of dynamics over time. So here I remind you things that everyone here knows, but I'm going to use this now, okay? That in the Money View, we think of the system as hierarchical, both domestic and international, that the prices of money are the price of moving from one layer of the hierarchy to another, interest rate, par, exchange rate on the left, and that there are dealers who are making those markets. There's also an international hierarchy. So as we were hearing from Pablo, that life at the bottom of this hierarchy is not so pleasant compared to the top, that you're basically, the dollar is hard money for you, which it is not, okay, in the United States. And it's not for the global north either because of the liquidity swap lines and so forth. So this is sort of this is an attempt that I've developed over teaching for many years to take the incredible complexity of the system and boil it down to, okay, a hierarchy with 4 levels. So it's obviously a simplification, but that's what a theory needs to do, okay, is to create a kind of simplification so that you can understand it at a level of abstraction. Instead of, you don't want the map to be as big as the actual system. And so this is the challenge in developing macroeconomics. And of course, what Keynes did when he was developing macroeconomics is to kind of move from the quantity theory of money to having these big aggregates, C plus I plus G plus net exports. And maybe those aren't the right categories for the modern economy. And so that's where I'm going to go with this. So in focusing on the liquidity experience, I think it's important to emphasize at the beginning that every agent faces the problem of managing their daily interface with the global system. By every agent, I mean you and me, as well as the United States, as well as, Meta and whatever. Every agent, that's daily, okay? Every agent also faces the problem of surviving periodic system-wide liquidity crises. We know about the inherent instability of credit. We know there's going to be crises. And so we need to have that in mind. And the problem of surviving a system-wide crisis is different from the problem of managing your daily interface, because you can't stop the system-wide crisis, right? You just have to survive it and wait until the rain goes away. The variety of liquidity experience arises from the variety of positions in the hierarchy of money and credit. And so we're not going to aggregate. We don't aggregate in the money view because the qualitative difference between different layers of the hierarchy is important and something that we want to understand. Similarly, we're not inclined to apply the same model to every layer of the system. We're not going to, say, oh, ISLM, that applies to Nigeria, or Mundell-Fleming, So we're not doing what the IMF does, which is say, oh, we have 150 cases, so let's just run a regression on all of them. From the money view, it's like, no. These are at 4 different layers in the system. Run a regression if you want on each layer, but not on the whole thing. You're throwing away information. You're throwing away information about how the different layers are qualitatively different. But the interaction of these layers is what leads to the macroeconomic variables that we see, both quantity and price. And that's what we're going to be in conclusions that I will have. I'm coming to think that somebody mentioned that price is determined by the marginal supply and demand. I'm coming to think that one of the things we need to do is to be attentive to when the marginal supply and demand sort of change in terms of which agents we're talking about. Is it in the consumer sector? Is it in the business sector? Is it in the government sector? Is it in the global north? Is it in the global south? So that we're not going to have a theory of the determination of quantity and price, okay, that is independent of which agents are the marginal suppliers and demanders. But I don't think. And so that's just a preview of one of my tentative conclusions coming from this. Now, why is this not moving? Okay. So I remind you that I have been using this sources and uses. So if you think about, so there's this asymmetry between deficit agents who have to find a way to settle. They've made a promise, and if they're a deficit agent, that means that ex ante, their sources are insufficient for their uses, and they have to find a way to settle. I want to distinguish, I think it's important to distinguish between real deficits, which is to say maybe goods and services where your expenditures are greater than your receipts, and financial deficits, which is when your accumulation repayment requirements and hoarding desires are greater than your sources. But either way, if you have an ex-ante deficit, you need to do something. Sources, liquidation, borrowing, and dishoarding, those are the 3 choices available to you, which, by the way, this maps on to the Brunnermeier and Peterson language of market liquidity, which is liquidation, and funding liquidity, which is borrowing. And dishoarding, some people call that monetary liquidity. And we will see as we go forward that different agents, a lot of the variety of liquidity experience has to do with the access that different agents have to these 3 mechanisms. And some have more access than others. If you can't do that, okay, then you're basically forced to work on the uses side, to cut your spending, to forego planned accumulation or hoarding. That's where the problem comes, where a possible cascade effects, because of course my repayment, somebody else might be relying on that, and that throws them into deficit if I default and so forth. We know all of this. But the result of all of the variety of deficit agents trying to meet the settlement, is there are aggregate results, and those aggregate results are prices, interest rates. Particularly if you're forcing on borrowing, there's going to be a price to roll over till next day. You have to persuade the surplus agents to help you, and that's what an interest rate does. And there's going to be consequences for GDP too, particularly if you can't find market liquidity, funding liquidity, or monetary liquidity, and you have to forego some uses. So here we go. Now, in all of this, I want to emphasize the centrality of funding liquidity, because as opposed to market liquidity and hoarding, dishoarding, expansion of credit, and also reflux, contraction of credit. Banking, and this well, Jay and everyone is remarking that liquidity is not the property of an asset. It's generated by institutions. Banking, this is my, again, attempt to create, there's a multiplicity of different kinds of financial institutions. So I'm going to say banking, generically, is a source of flux because of the ability to expand the balance sheet on both sides. And mostly this is sort of short-term money market stuff. Financial intermediation is the source of reflux. This is where long-term assets can ultimately reside, get off the balance sheet of the bank, portfolio preference. You might have seen in the chat when I was talking to Danqing about thinking about this digital currency thing, that he talked all about flux, but not about reflux. Okay, and so that may be the next step in thinking about that policy. This shows up, this elasticity at the level of the system and also reflux in the price, and we think about the term structure of interest rates as the price mechanism that is coordinating that. There are dealers that are making these markets, and so the term structure of interest rates is fluctuating around. Here again, we might think like, well, where does the interest rate come from? We tend to think of the short end, the overnight rate, as sort of a policy choice by a central bank, and the long end as being a market choice. But how exactly the policy choice is not, in the money view, we don't think of that as a free variable. You can't just set the interest rate anywhere you want. There is a theory of what the overnight rate would be if the central bank did not monkey with it. And so the central bank is intervening into a process where the market itself is trying to determine the overnight rate. And that's maybe distinct to the money view as opposed to standard macro, which does treat the overnight rate as a free variable that the central bank can set wherever it wants. So I'm not going to talk about domestic varieties. How am I doing on time here? It's 12:36. What are my constraints?
We should get about up until 45 or 50.
Oh, I'm not going to need 45. Okay, fine. So you're saying until 1. I'm going to be done before 1. So domestic varieties. So I think it is useful to, although I say it's not useful C plus I plus G, maybe it's useful to think of households, businesses, and government as different agents with each one with its own specific variety of liquidity experience and differentiation inside each of these sectors too, for example. So the most basic, variety of liquidity for people who are very constrained, who face binding liquidity constraints, they get wages, maybe even day wages, which they have to pay for food and housing. And they're basically just hoarding and dishoarding. They're paid at the end of the day in cash, okay, and they pay their landlord from that cash, or they pay their local supermarket in cash. Higher up in financial inclusion, so to speak, there are other sources of credit that relax the survival constraint, with the help of everyone in this room has a credit card. They may not have the $25,000 borrowing limit on it, which I do. Maybe you have a home equity line, which is $100,000 or $200,000. Maybe you have a mortgage. Maybe you don't have a mortgage. Maybe you have a retirement account, which is what 401k means for non-Americans. A retirement account which is taken directly out of your wages and invested Fidelity or TIAA or something like that, which you can tap, in emergencies. So this layers of financial involvement with the financial system. Somebody like me, is basically in the top few percent, and I'm not liquidity constrained basically at all. but that is because there are financial institutions that are taking that constraint. They are providing me with the ability to slap down my credit card and buy something, very expensive, right now, and that's not true for everybody. And notice that I'm distinguishing here too between short-term credit and long-term credit. I think that's important too. Money market and capital market. We need to distinguish so much of that. You're going to see that be even more when we get to international. So businesses, their source of short-term credit, commercial paper or bank lines of credit. And then IPO is initial public offerings. This is equity, stock. They're in the goods and services account. They're selling things, but they're buying things from other businesses. They're paying labor, and they're making profits. And it's those profits that are going to pay the interest rates on their bonds and commercial paper and so forth. If they're hoarding and dishoarding, typically, it's much more important, the institutional money market mutual funds, because of the constraints on deposit insurance, the limits on deposit insurance. So it has been typical that businesses want, they want to know what the assets are. And that's what money market mutual funds let you know. You see what the assets are. Silicon Valley Bank was a little bit of an exception in that regard. We're going to come to Silicon Valley Bank. Government is also in the short-term and long-term borrowing business. They're not selling anything. They're imposing taxes and they're making transfers, or they're buying reflecting pool sealant, and they're spending money on something. I make a point about their hoarding and dishoarding, that they have an account at the Fed. From the point of view of the federal government, anyway, the Fed is the government bank. And if you look at the Treasury account, it fluctuates quite a bit, as a matter of fact. And it was the key account during COVID for making all of these payments. So the whole point of this is to say, well, here are these, and of course there's government, there's also municipal government, there's state government, which are more constrained legally, and the current spending versus capital spending. So there's varieties of liquidity management within government, within businesses, within households. And I want to think of each of these are sort of the primary borrowers and lenders. But then there's all of the infrastructure intermediaries. And as I said, I want to think of bank balance sheets. And I'm showing the issue of banking deposits here as a financial liability, because from the point of view of banks, it's not money, right? It's credit, right? So I'm putting it as a financial liability. From our point of view, it's money. So things change which line they're booked on depending on whose accounts we're looking at. I think I'm still trying to find the best accounting representation of this, but this is my current attempt. For the banking, reserves at the Fed are a possible use. That's money, and the discount window is a way to borrow that. And they're the intermediaries I'm showing here for all of these short-term loans, the households, businesses, government, and also long-term loans. That's what CM is for capital market loans. That's, of course, different banks. It's a very differentiated structure. And this is an analytical point, not about particular institutions. Now, you might take this analytical structure to the real world and look at the institution and saying, are you a bank? Okay, or are you an intermediary, the credit, but sort of stockpiling it, so the pensions, insurance companies, mutual funds, and so forth. So that's where the reflux goes. The bankings create these forms of credit, and then any excess money balances flow back out through reflux because the pension funds buy them, insurance companies buy them. That's the idea. Okay, now international. It's a global system. So the notion that we now are done, that we can think of all of these, consumers, businesses, government, banks, that now we have enough to think about the determination of GDP, the determination of the price of liquidity. I think the answer is no, we do not, because the country itself it has an interface with the global system that is both trading networks and also financial networks. And so all of these prices and GDP are actually determined at the global level. So this is I was impressed that, Pablo found some international stuff in he realizes that this is happening in exciting, but he doesn't really understand it. It's not part of his original equipment, where he's formed in the 1950s, right? When all of these international things had broken down. And he's trying to extend that, particularly under the influence of his friend and colleague, Charlie Kindleberger, who started from international and then found Minsky later on, as a matter of fact. International. So remember our hierarchy, that at the top is the key currency country, then the global north, then the global south. So these are going to be quite different in how they interface with the global system. I'm saying here the United States, I'm showing it as having a trade account deficit, which is financed with a capital account surplus. I like Pettis and so forth, that they use the Keynesian framework, C plus I plus G plus X minus M equals Y, which is the national income and product accounts. And it basically is not talking about the flow of funds really at all. It's talking about the flow of goods, okay? And the actual and to the extent that it talks about the flow of funds, it's a net capital account. It's like, if the current account is in deficit, then the capital account has to be in surplus, or something like that. We don't do that in the money view. We are thinking of the key currency country as being bank of the world, okay? That it is borrowing, again, those borrowing by the New York banking system, I'm showing it as increase in liabilities in the money market. That's actually the reserves that the Eurodollar system runs on. They're accumulating, assets on Europe, or on the rest of the world. Those things net out largely, if you're just looking at the net capital account, you won't even see them, because they're inflows and outflows that net out. But from a money view point of view, the gross exposure is what you want to be paying attention to, not the net exposure, because you are responsible for your own liabilities, okay? And whether or not the person who you've lent it to pays you. You can't say, when they pay me, I'll pay you. No, you're responsible for paying. So the liquidity point of view makes you look at gross exposures. And the gross exposures are an order of magnitude. I mean, most people here know that, but if you don't, are an order of magnitude larger than the net. And of course, the gross exposures fluctuate and sort of cause the net capital account. So you could even go so far as to say that it's quite possible that the net capital account is driving the current account, not the other way around. And some people have said that, and certainly that's true at some points in time. So having a broader perspective and not just sort of having this fetish of the real imports and exports is quite important for understanding the interface of the key currency country with the global system. Farther down, it's also true. So now I'm going to distinguish between structural and cyclical. Here I give credit a little bit to Kindleberger. He is trying to create a categorization. Some of you have seen this in other forms, in other presentations, but not in this form, where we think of the as being general rich countries, and so they're creditors in long accumulating assets on the rest of the world. So that's accumulation. But when they get mature enough, like Britain, they're liquidating them to live off of, and so that's the green, and maybe even borrowing bond issues. Both of these, young creditors and mature creditors, are getting their liquidity through Bank of the World. So as their economies are growing, they're increasing their reserves, and they're doing it not by running trade surpluses, okay, but by borrowing and hoarding. Okay, so that's why I put bond issuance there and hoarding. That's with the Bank of the World. That's with New York. Okay. So those are structural. Both of those are structural. Okay. Layered on top of that, which makes it hard sometimes to see the structural stuff, is that all of these countries are using the global money market as a balance of payments buffer. So they're borrowing and lending depending on their balance of payments, managing their balance of payments. And when you see measures of the capital account, typically you see that the net and that dollar borrowing for short-term purposes, is just lumped in with borrowing and lending for long-term purposes. I think it could be useful empirically to see if you could tease that out a little bit. And it's maybe impossible, but at least analytically, I think we should tease it out and be careful to notice, that if a country has a capital market deficit, capital account deficit, is that cyclical or is that structural, or what exactly is happening? And are they issuing bonds in order to accumulate dollars? Okay, we probably don't want to think of that as a capital market deficit. Those things net out. So this is being a little more sophisticated in our understanding of liquidity experience. The global South, I'm not putting a cyclical thing for them so much because they typically do not have as good access to global liquidity. Pablo said he's a big believer in hoarding reserves. So there he is in purple, hoarding reserves. He may get those reserves by borrowing in global markets, not by running trade surpluses. So using the Bank of the World. So Kindleberger thinks of the global South as people just starting out are borrowing for development, issuing bonds in the global market. This has been, Pablo was telling this story about how initially, before the East Asian crisis, that's why I asked him about the pivot point, that before the East Asian crisis, basically the government was borrowing in global money markets, and on lending to domestic industry in local currency. So they were taking the currency risk, they were taking the maturity risk, and the East Asian crisis was when all of that came to an end. They were borrowing in global dollar money markets because that's where the money was, For development, you want to borrow long term, and ideally you would like to borrow in your own currency, but it may not be possible. And the government was taking on that risk, in order to foster economic development, which more or less worked. I mean, the Tigers did advance, but there was a crisis, okay, and the model then changed. And certainly since the financial crisis, the champions of the global South, companies, can now tap global capital markets themselves, often at pretty high interest rates, but as I say, some of that was made possible by the fact that the financial industries of the global North, pension funds and insurance companies, cannot operate with zero interest rates. So they sought out sources of positive interest rates in the global South, and having found those sources, that's not going away. This is now, I think, permanent, that the global South has joined the global North and the global dollar system in a big way. And that's going to be, as they were starting to do it, you read the BIS papers just as I do, there's a lot of worry. Oh no, there's all this credit going there and that's dangerous and maybe they're going to default. But maybe not. Maybe this is just the next wave of global economic development, depending on what they use the money for, and so we'll see. No doubt some of it has been wasted. No doubt some of it has been for good things. And the next time the tide goes out, we will see. This is the way the system grows, by fluctuating. So this is another variety. Now, I want to insist again that despite this variety that is domestic, households, businesses, government, and also within each of these categories, there's varieties, and there's varieties within each of these. Some of these will have done stupid things, and some of them will have done smart things. Same in the North. Despite all of this variety, I think it's useful to insist that there's one price of money that applies to everybody, one global, that all of these markets are interrelated through arbitrage, and there's one price. That doesn't mean that it's exactly the same price. There can be spreads and so forth, but all these prices, there's a structure of interest rates, but they move together. They move up and down. Together. And the same is true of the capital market, that there's one price. Now I mentioned this at the very beginning. I'm coming to think that one way forward might be to try to think about in each moment in time, what is the marginal source of these prices? Is it private or public? This is where I started. It's very clear that the system operates quite differently. But maybe that's more generally true. Maybe there are times when sort of business finance is driving things. If you've read Minsky, you know that his is a story all entirely about business finance, actually. Whereas the global financial crisis of 2008 was clearly about household finance. It's about mortgages, right? And so we need to just bring up to consciousness that the shifting marginal source of price it can change over time, and the money market. Oh, it's already 12:56. Okay, fine. The money market versus the capital market term structures similarly. So understanding the variety of liquidity experience, I think, opens us up to the possibility of understanding the variety of causes of changes in quantity and changes in price. So here's the final 3 slides. So here's just a measure of quantity and price fluctuating. So this is the global financial cycle. This is from the BI. And notice that there's a price-based global factor. So these are quantities of credit. So there is inherent instability in the global financial system, and this is what every agent is trying to protect themselves from. Is this or take advantage of? To think of the other way around. That the financial cycle is global. Okay, it's coordinated. That was maybe not true in 1950, when Minsky was writing, because these countries are quite separate, but they are now not separate. It is one system. I remind you, so this is again to differentiate, that U.S. monetary policy is global monetary policy. It's to the extent that the short-term rate of interest is set by anybody, it is the Fed. It is the Fed. Every other, and this goes back to Kindleberger, so this is not new. This is old, that other majors manage interest rate spreads in order to affect the balance of payments, and minor currencies, have capital controls. We've heard of some of this, that just simply moving the price around doesn't give you enough leverage. And in very poor countries, there are no financial markets, and it's the central bank and the treasury that makes the market. I remind you that the U.S. central bank is the global lender of last resort, but mainly for the United States, and as you go farther down the hierarchy, it's supporting less and less of the system. So this idea that there's overnight markets, 3-month funding markets, and 10-year bond markets, those are the three trainer models there. And so supporting the global north, you're supporting funding markets through the liquidity swaps. Supporting the global south, you're only supporting payments through the FEMA repo facility and so forth. So it's differentiated backstop as well. And I think maybe this is my last slide. This is an idealization. This is the kind of thing that I want to do for macroeconomics, where I'm showing the new thing since 2008 is that the emerging market economies are issuing dollar-denominated bonds, which are being held by Japanese insurance companies funded in France. So that's shadow banking that is global. And it's also the expansion of the global dollar system to the global south. Okay. And that this is key thing here is that this is backstopped by liquidity swaps. The Fed doesn't have liquidity swaps with the global south, but it does with the Bank of Japan and with the European central banks. And so that's what is backstopping this whole thing. And that is the world that we live in, the varieties of liquidity experience. And I will stop here at 12:59.
Thank you. Thank you, Perry. Okay, so let's do a round of comments. We were supposed to end here. I don't know whether the Zoom is going to stop, Jay, because this was we made it until 7, the conference. No, it's not going to stop. That's good. Okay, so let's do a round of comments. Maybe if you guys could raise your hands with the hand raise thing, so we know who is going to comment. We have Alex, Anush. I want to make a comment. Anybody else? Just to have a sense of how much we can let people speak. Okay, so I guess it's gonna be the three of us. So let's do a round of comments and then Perry can respond. Alex?
Yeah, so I really like the unity and variety slide. And I think it's the perfect response to Joe Michel's presentation from earlier today. I'm curious if you already had that slide, or if you added it after we talked. When you showed up and I explained that talk to you, because it's exactly what was in my head when he was presenting. So did you come up with that on your own already. Before?
Yeah.
Wow.
Yeah, I had that.
I
wrote
is amazing.
This yesterday.
Okay. All right. And then my question is, does a correct macroeconomic model have a Hahn problem, right? Does a positive price of money have to be predicted by the model? And the same thing for quantity. Is it okay for a macroeconomic model to have a zero quantity of money, like Michael Woodford's cashless limit? Does a positive quantity of money have to be predicted by the model?
Anush?
Thanks, Sasha. Thanks, Perry. This is a really nice reformulation. But before I get to comment on that, just the slide on the U.S. households interfacing with the rest of the world and using the Bank of the World and that particular interface. Were you showing U.S. households as surplus agents there? Because U.S. households tend to be borrowers, and I mean, especially in the financial crisis, it was sort of rest of the world savings, the whole so-called savings glut, funneling money the other way into deficit households. And those households were deficit because, of course, there's like a structural problem in most global north countries, which is that you have massive inequality. And so you have, people at the top who are making much more than they can ever possibly consume. And you have sort of the norms of the system require that, each generation does better than the next. And so, but you have that in the face of collapsing wages or stagnating wages. And so you fill that gap with debt, right? So the interface with the rest of the world, it seems to me, for the global north is one where accumulating developing countries in the global south fund the losers, i.e. the winners from globalization, fund the losers from globalization through the intermediation, right? The export agents who are taking, all the jobs from Detroit and, Apple being produced and so on and so forth, they are funding the mortgages and credit card debt of the losers from globalization. So that strikes me as that particular story. But that's just to zoom into that interface. To zoom back out, I think this, in a sense, the variety of liquidity experience can be framed as the variety of survival constraint. How it the way, and it's just, I mean, the survival constraint is a liquidity constraint. So it's just the different ways in which the constraint sort of binds and how that gets configured. But I want to ask you to reflect on bringing in hierarchy here, right? Because in a way, if you reframe it as the source of the survival constraint, you also therefore then have to perhaps go one step back and inquire into the source of the surplus or the source of the deficit for a particular unit. Why are some units surplus and why are some units deficit, whether they're household, government, or businesses? And then ask, are those surplus or deficit relations, just as you were, are those relationships structural or cyclical? And then you start to get something like a class hierarchy, right? There are kind of, structural surplus agents, we call them rich people. And there are structural deficit agents, we call them working people. And therefore, who then gets to set the terms is not just a sort of happy equilibrium that emerges from the interface between surplus and deficit agents, as if the identity of those agents changes, right? That would be almost like a kind of Adam Smithian story, in a sense. But in fact, as we know from the long-term inequality work that Piketty and others have done, the identity of these structural surplus agents is quite stable over time. It's inherited almost, right? And so likewise, the structure of the deficit agents, that's the domestic piece, and then the international piece is then sort of trying to push up against that, but of course within global South countries. So I suppose my point is that if it's a variety of structural constraint, it's a variety of survival constraint, and there are various sources of surplus, but those sources of surplus are quite stable over time, and the surplus agents are the ones setting the terms. This is my typical way of just taking what Perry has just said and making it more political economy. But I feel like that gives it a slightly different spin, so that it's not just macroeconomics, it's also a kind of macro political settlement as well.
Okay, let me do this last comment, and it's kind of related to what Anush was saying. So one thing that I also thought of it as a varieties of liquidity constraint, and I thought there maybe if we think of liquidity or survival constraint as like a money view reworking of the budget constraint as a concept, right, which exists in a kind of non-money view type of economics, then I guess the thing that I was thinking about was, okay, if we are talking about the hierarchy of survival constraints, then what matters is really how high you are in the hierarchy and in what kind of bank can you tap into, right? Who gets to create the money that you end up settling in, right? So that the survival constraint is not equally binding at the bottom and the top, right? And this is maybe going more like towards simply like just the fact that, like Fed creates liabilities that settle, in Fed's liabilities. There is no further ultimate means of settlement above it, right? And so, and then, to the extent that you have access to Fed or to the US banking system, you have access to something that doesn't ultimately need to settle, right? And I here remember even what you told us when we talked to you about the bank dealer model, right? Where you said, well, ultimately it's not about like an inventory of reserve. It's really about never having to kind of, provide reserve to anyone, right? To settle in reserve ultimately. So we have even this elasticity on the same level, right? As long as the participants on the same level in the interbank system, let's say, are willing to expand the interbank liabilities and claims amongst each other, right? With them, with the idea, okay, let's not have them expand infinitely in a very short period of time, but and hopefully they're going to shrink at some point and so on. And so I guess that's kind of removing this funding part and the reflux part to some extent. But again, I guess the question is the reflux and the funding really as important as we get high in the hierarchy? Right? Is it really something that is an extremely important question that needs to be solved when we are dealing with like low and entities low in the hierarchy, which are kind of facing a hard budget constraint, whose survival constraint ultimately depends on either simply earning or ultimately borrowing, but will they be able to? Or liquidating their assets, right? Like, and will they be able to do that at a good price? Versus those up in the hierarchy, where ultimately the funding question is automatically resolved somehow, if that makes sense. And the other comment in relation to what you were saying is that there was no dealers today. So that's something that I found curious, right? Because when you talked about arbitrage as what ultimately unites the system and creates one price, I was imagining you would see dealers there, but you said arbitrage, and I'm not sure whether there's just a matter of words, or maybe it's really more a matter of two different ways in which the kind of the coherence is given to the system, where dealers are one and arbitrage is another. Or is that a meaningful thought? Okay, those are the comments.
All right. Thank you. So thank you, Alex. You liked my unity and variety slide. You're asking me now to respond basically to your talk and with your question about the Han problem and does there have to be a positive quantity of money? I guess my own feeling, okay, is that the reason that some financial asset gets chosen as money is because it's sort of a structural surplus agent at the settlement, so that everyone needs to acquire its own liabilities from that agent in order as a way to pay it, and that's true at different layers of the hierarchy. I mean, banks run their balance sheet. Classic banking, real bills banking, right, was an attempt to create a structurally surplus agent, because every day some of those bills would be maturing and someone would have to make you a payment. And so that your source of liquidity was the fact that everyone has to pay you. And you can then turn that into a business, and in fact, the Bank of England was modeled on that same thing. Now we have nation states that have taxation ability. That was not true, 100 years ago, and so we now think that, that money is inherently a nation state thing, but that's because of the evolution of political economy, that states now are seen, they have taxation authority, which they didn't really have before. It's worth remembering that states used to rely on tariffs. Mr. Trump is moving us backward in time in this regard, because there were a little bottleneck, where you could conceivably grab some of that, as it's flowing in the ports, or even confiscation and recoinage and stuff like that. The history of weak states, where the best money was in fact the merchant's money, is worth remembering. Anush. Yeah, and in fact made this realized this. Yes, it is. I am definitely thinking of, when I say the variety of liquidity experience, it is also the variety of survival constraints, that appear in different ways at different layers of the hierarchy. I will say that it appears everywhere in the hierarchy. It is just not true that at the top of the hierarchy you don't face a survival constraint, but it does take a different form, and I'm going to say some things about that. Some of the comments you made, Anush, trying to move me in a political economy direction, are moving away from money view in the sense that when I speak about a deficit agent, I'm speaking about deficit at the settlement, right? I'm not speaking about somebody who doesn't have enough money or something, who's poor or something. I'm speaking very specifically about deficit at the settlement. That's entirely possible for rich people to have a deficit at the settlement. In fact, they often have very illiquid investments of some kind. And so when you try to raise money from them, they say, I have to wait for a liquidity event, i.e. the IPO or something like that. And then I can give you $10 million. But today I cannot give you $10 million, because I don't have $10 million. So I am very specific. And so Sasha suggested that maybe I'm reworking the budget constraint. I am not. And I need to be very clear about that, that the settlement constraint is not a budget constraint. The budget constraint is a solvency point of view. It's a wealth point of view. And that where, the standard consumer theory, right, is that consumers are trying to spread their wealth over they're trying to consumption smooth over time or something like that. That's not the image here. The image is that the day has come when my debts are due, and can I pay them or can I not pay them? And if I can't pay them, what can I do instead? And that has nothing to do with how wealthy you are. It has nothing to do with I just said that already. But you make me realize that even in this community, I need to be sharper about that and make very clear when I speak about a deficit agent, because the word deficit and surplus, for example, is used in NIPA terms, right? So, you're a deficit agent, that means you have a trade deficit or something like that, and it's like, no, that's not the way I'm using this term. As if a country is a deficit agent, it's because their capital account and their trade account are jointly, uses greater than sources. Okay, and so they have to find another source somewhere, and so that which maybe they have enough reserves, but in general, 30% of GDP. I was amazed to hear Pablo Bortz willing to put 30% of GDP there. That's because these countries do not have liquidity swap lines with the Fed, or they don't have developed financial institutions so that their domestic banks can do interbank trading with banks in New York or something like that, that their credit line in New York is limited. And so there's not a private swap line, nor is there a public swap line. And so that's why they're accumulating reserves. So that says that their liquidity constraint is very different from countries higher in the international hierarchy, and so forth. I'm very willing to, go with you to say that, Dario. I think you saw his paper earlier on, Anush. He was making the argument that it is rich people in the United States, who are accumulating the subprime mortgages of the poor people, that was sort of his little model here. And you're just taking that one step further to say, well, it's actually rich people in the global South, who are doing this. So I think that's fine. And I think that understanding the determination of wages and the distribution of income and all of that, that's going to be part of the story. I'm not at all opposed to the notion that there's class hierarchy and that rich people are privileged and so forth. So I want to end with this idea. So Sasha asked me about, is the liquidity constraint basically relaxed higher up? So in chapters in my book, I think I'll mention these two cases because maybe you've seen them in other talks that I've given, and I'll just remind you of them. That for example, there are two. One, I talk about flux and reflux. In terms of a bank that is making a mortgage loan to me to buy your house, And they're doing that by expanding their balance sheet on both sides. Okay. But you don't want to hold cash, nor does society want to hold cash. You want an annuity because you're selling your house in order to retire. And so an insurance company, you use your deposit accounts, you transfer them to an insurance company, which then transfers them to the bank to buy a mortgage-backed security in order to fund that annuity, because it sort of lines up. The consequence at the end of the day is that the bank now has liquidity again, right? Because it's shrunk its balance sheet back, so that it can now do it again for somebody else, and this shows, the banks have to worry about somebody taking out the money and moving it to another bank or moving it to another country or something like that. They face a binding survival constraint, but there are very organized interbank loans, interbank markets for short-term shortfalls. And in fact, probably the first thing that happens when you take the money from selling your house is you deposit it in your bank. And then the next thing that happens is that my bank borrows from your bank in the Fed funds market so that no reserves have to move, but that's short-term. The question is, is society willing to hold this new money supply? And if not, then there has to be reflux. And that story about the insurance company is the reflux story that gets you back to where you started, so that you can do it again. That story in general, that's in my flux reflux paper for the Sheila Dow FESRIP, which is on my website. But the same is true higher in the hierarchy too. If you think about government war finance, Jane DeRista wrote about this, in her great book, and I turned this into little balance sheets in my book. That how did the U.S. fund the war? They taxed but what they did was to borrow from the Fed. So the Fed is expanding its balance sheet on both sides, and they also borrowed from the banking system, which the way they did this was that the banks lent money to their own customers to buy treasury bills. So they borrowed indirectly, and then that all refluxed, and then they did it again. So war finance, it's true even at the level of the government that flux and reflux, with the central bank, not just with the banking system, but with the central bank. So these principles are apply at all levels of the hierarchy, but they show up in different balance sheets, and different ways. The central bank is a bank. It is a bank. And it's true that Fed liabilities, are only settled in Fed liabilities, but there are in the government, in the war finance situation, the Fed becomes the government bank. That's, in fact, they during wartime, typically, the only way you can get a loan is by getting it approved as necessary for the war. So you can't, credit is blocked for everybody else, except for the government. It's privileged, the war effort. And that's very similar to kind of what you might do if you were trying to use the state as an agent of economic development, right? That you can't borrow money for luxuries. You need to be at least pretending to do economic development or something like that to get your loan approved. So maybe
Sasha's point still holds, right? Even in normal times, forget war and development, why can banks relax household survival constraint? Because they've arranged the balance sheet in a way that
they can relax. Banks can
less on them.
Banks can relax household survival constraint because that is a survival constraint in which the bank deposits are money. But banks' own survival constraint, requires access to central bank money. The banks can't relax their own survival constraint. They can only relax the survival constraint of people below them in the hierarchy.
I would just say, Perry, but if you look at, so what you're basically saying, the expansion of the balance sheet of a bank is a dangerous thing for the bank. Short term, maybe they can deal with it, but over time, they don't want their balance sheet just to be expanding constantly. But then we look at the Fed's balance sheet. And in fact, if we look at it historically, it's expanding constantly over the decades. And it's not a problem at all, precisely because ultimately, US is a deficit agent, and that is not a problem, right? In fact, having ever larger Fed balance sheet does not necessarily create a problem, because settlement of its liabilities is in its own liabilities, right? At that level, there is no more interbank system that holds Fed accountable. To the extent that someone has privileged access to the Fed's balance sheet, and we can say the US banks, first of all, do, then those entities will be facing a survival constraint that is not as binding, as disciplining as it is somewhere down the system. That would be the point.
Well, yes, we are doing war finance in peace.
And much than Trump, since 2008.
I don't think the US is a deficit agent necessarily. It's just that there's the other side of the balance sheet, which is it's just leveraging up its GDP more. That doesn't make it a surplus agent. It's just that its price to earnings ratio, if you like, is going higher, right? And it's there's still a balance sheet there. It's just being leveraged up more. It's not a deficit agent. It's just saying, okay, I'll pay you back. And of course, the US can hyperextend, but it doesn't have to be. I mean, there is this trope in IPE, Mark Schwartz, etc. This notion that the US has to be in NIPA account, or the provider of the global reserve has to be in NIPA terms deficit as an agent, right? But that's sort of like missing the asset side of the balance sheet, right? And so I don't think it's deficit in that sense, but it's still able to bend the survival constraint further than any other balance sheet, right? So that's sort of its differential power.
I was just reading the chat, and I hear that my audio was stuttering.
Yes.
Probably that happened when I was changing slides, because I don't have that much bandwidth here. So but I also could have moved closer to the modem, and I will, if I had known that, I could have set up closer to the modem.
We did hear you.
Okay.
Thank you.
I have my very best Yeti microphone here. So it's not my microphone. It's the bandwidth. Yeah.
We are going to close here because we are already half an hour over time. Thank you, Perry, and thanks everyone for being with us today. All of this will be online, and you will be able.
Thanks for organizing, guys. Well done to the organizers.
We are hoping to gather you, as many of you, in Piedmont in October, in the first week of October. We'll be in touch. Thank you.
Bye-bye.
Bye. Bye.